And does that now give them the clarity to understand what resources they have for dealing with potentially a Hezbollah conflict as well?
I'm sure they do. It's a very competent, force in general, the IDF. They are pulling people out, but you have to remember that, they mobilize large numbers of reserves to create, more than 300,000 troops. Some of those they'll want them back at work. Some of them they'll want to just rotate and rest. I don't think there's anything imminent, no sign that the Israelis are suddenly moving large forces up to the north to invade Lebanon, which would be a large project.
Mark, we will watch for the ongoing coverage. Thank you very much indeed for keeping us updated. Bloomberg Opinions, Mark Champion. So let's talk about how these strains in the supply chains are affecting what is happening around the world and the global economy. The uncertainty is hitting luxury businesses around the world. Champagne, absolutely no exception. We're going to have an interview with the Moët Hennessy CEO. That's next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
So sales of champagne went down last year. Tells you something maybe about what's happening with the global economy. And this year could be maybe as tough as well. Anyway, over the weekend, my good friend and colleague, Manus Krani, spoke to the CEO of Moët Hennessy. He was talking about inflation and how this is affecting the company's day-to-day business as well. He spoke to Manus at the National Retail Federation annual show in New York.
At this stage, I think you have to take it as a context piece, which affects what you do on a day-to-day basis. We have set up 2 years ago a team which we call Revenue Growth Management, which what they do is that they simulate the effects on the consumer elasticity of price increases, so that we, on one hand, we are trying to adapt our prices to inflation, also the inflation of our costs, because grapes get more expensive, salaries go up, transportation is more expensive, and very importantly, glass has become much more expensive. You know, in some products, glass can be up to 50% of the cost of a product. So if that goes up, you have to adjust for that. So revenue growth management will, on one hand, you look at adapting your prices to your cost, and on the other hand, of course, you try to mimic what will be the elasticity of your demand in the different markets, so that you kind of predict what the impact be, and you kind of readjust on that base.
One of the great accusations that I've come across is that the retailers and the producers jacking up prices, gouging the consumer, greedflation. Push back against that. I mean, is there any hint of truth in any of that, or is it just overstated?
No, that's clearly overstated. I think what we all try to, I mean, there's customer elasticity. If you go too far on your price side, you are going to lose out. So it's clear that we need to cover our costs, and costs are increasing. Sometimes we anticipate cost increases. Sometimes we come behind, but we have to adjust. But I think in the world of luxury, which we are operating, of course, with every price increase, you have to think about your product. Does the product yield that value? You know, in the last years, as long as I've been in this industry, there's constant investments in improving the product. For instance, since I've been at Moet Hennessy, we have gotten rid of insecticides. We have gotten rid of herbicides. That has created additional costs, but it also gives us a better product at the end. And so we are constantly investing in making our product better and better. Of course, that is on the product side, but then you have to transmit that to the consumer. And the consumer, the way you transmit it to the consumer is, of course, at the point of sale. So, and here we are back to retail. So what does retail do to the consumer, and how do we bring over to the consumer the fact that we sell quality products and yet their prices increases because of inflation and because we constantly invest in them, and yet we want to seduce the customer to stay with us or come to us as we go this way.
If I say to you this year relative to last year, how much will a bottle of Dom Perignon go up by? I mean, will champagne go up by 5% across the board, or will you be able to take your premium brands higher than that?
It really depends on the brand, and it depends what we have done so far. So some brands we have increased quite a lot, and we are going to be more on a stable base. I would say 2024 will be a year with probably more moderate price increases, because we took some price earlier last year and middle of last year. So we kind of monitor this very carefully to be sure we are not leaving the world of the consumer expectations too much.
We've got a couple of different issues at play here, haven't we? We've got still a number of events, live wars in the world. You saw a drop in your market share in China, in Russia, and that perhaps transferred into the Middle East. So where would you say are you banking on for 2024 to bolster the numbers in champagne and in cognac?
Well, we're optimistic on the American markets, as we think that we have gone through this kind of readaptation, and it's back to normality. We continue to be optimistic to continue the very nice growth we had in Southeast Asia. Travel retail has been doing very well for us. So travelers have been out there. They've been buying in airports at a very high rate, and we hope to continue that. We continue to believe in most parts of the world, but we also are concerned, of course, about all geopolitical situations which are...
How much attention do you pay to that? And I ask you that question because people in this room will have lived through the supply chain crunch. We've got issues in the Red Sea. Huge amounts of global floating trade are now being diverted around the south of Africa. How concerned are you about a jolt in the global supply chain?
Well, we all know how important supply chain is, and if there is a problem through the passage through the Gulf of Aden and the Suez Canal, I mean, it means, of course, an impact on energy costs. It means an impact on transportation timing and all that. I mean, we have decided to change to a few years ago to 100% transport by sea. We don't do any air freight anymore for sustainability reasons.
So this is a particularly important issue.
So for us, it's very important. Everything goes by boat. I mean, fortunately, our products are non-perishable. So if they take a little bit longer to get there, it's not a problem. But of course, we are worried. But I would say more general, I would say we stand in a way for free trade as a category. We believe in free trade and in free trade of cultural goods as a big way to bring humanity together. And in that sense, what's happening these days is not very reassuring.
Moet Hennessy, CEO, speaking to Bloomberg's Matt Cranny over the weekend. takes a little bit longer for the champagne to get there. Maybe it'll taste a little bit better with aging. Okay, let's talk a bit about where we are with markets right now. It is a US holiday. US markets are closed. Volume, therefore, is light. I'm not sure you're getting much of a price signal. Stocks are a little softer. There's a few earnings notes out there today. S&P futures are absolutely flat. The dollar's catching a little bit of a bid. Anyway, we've got much to talk about. Are you more convinced about what this year looks like than you were at the beginning of this year? Themistokleos, UBS Wealth Management CIO EMEA, joining us next to discuss. This is Bloomberg.
All this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Monday, the 15th of January, European stocks a bit softer. I have to say there's a number of analyst calls out there that are actually having a bigger effect right now than anything else. It is obviously a holiday in the United States. Volumes, therefore, are light. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So stocks are a little bit softer in Europe, but we don't have the price signal coming out of the United States, as a result of which I think we'll have to wait for tomorrow before we get a decent price signal. We're softer. We're down by 0.6%. There's some heavyweights downgrades in the market today that I would argue are probably having the biggest effect in terms of the index calculation. HSBC is one stock that is down quite heavily and is dragging on London. That stock is down by 2.2%. You've got a note out today from BNP Paribas Exane talking about the risks going forward for this institution, talking about the potential for maybe lower shareholder returns. going forward from here. The downgrade there having quite a big effect. So that stock is softer. L'Oreal's another case in point. Actually, it's why the French market is underperforming today. So L'Oreal is down by 4.6%. Now, L'Oreal, relative to the rest of the luxury sector, has had an okay run. And I think it's UBS out with a note on it today, talking about that maybe relative to the peer group, relative to what's happening going forward, a lot of the good news could be in the price. So L'Oreal certainly acting as a big drag today on the CAC Querance. That stock down by 4.5%. There's a lot going on. We've been dealing with, obviously, the inflation narrative today. We've got a lot of commentary there coming out of Davos. We've also got what's happening in the Gulf of Aden to talk about as well. And it takes us to our question of the day. Is the outlook for 2024 becoming clearer, or dare I say it, a little bit murkier? Let's talk about this. Bloomberg's JP Barnett joins us out of Germany. Heather Burke joins us here in London. Heather, you're standing next to me. We came into the beginning of this year, soft landing. It's going to be great. We're going to have rate cuts. Stocks are going to do well. Bonds are going to do well. It's going to be a fantastic year. Do you think that's beginning to fray around the edges a little bit?
I think what we've seen since the start of the year is a bigger disconnect between what people are pricing in terms of rate cuts and what central bankers are saying. I mean, in Europe, for example, it's about 6 cuts priced as soon as April, and you had one of the policymakers, Robert Holzman, coming out today saying, okay, this isn't really necessarily feasible this year because of inflation still sticky. We might even be near a recession, which we saw in some muted German economic data. Stocks have stayed kind of in a pretty tight band, but there's still this disconnect that it seems that the markets, stocks and bonds, are more optimistic than policymakers, and I think that's kind of muddling the path. Until we see that break, we're still in kind of a Goldilocks economy, but I think between the central bank meetings later this month, big earnings season really kind of starting to kick off, and of course the continuous economic data, there is a possibility we might get more of a clear outlook in the next few weeks.
JP, let's turn to you. It seems at the moment we're in a kind of scenario where there's not an obvious reason to buy, but maybe there's not an obvious reason to sell either. To Heather's point, do you think we're going to get clarity on whether which of those two forces are going to be greater this year over the next few weeks?
Well, I'm not so sure if we get to a point where we can say like one of those forces is completely taking over. We might, but I guess like there's so many things and I have so many questions about like so many issues, and I guess investors as well, that it's going to be very hard to pinpoint to say like if this and that happens, then we have total clarity of for the path for risk assets. We have the inflation topic, we have the rates topic, we have the topic of a bond issue supply, which is not even addressed yet. We have the topic of the Middle East, the Red Sea. We have the China-Taiwan relationship, and we haven't even talked about the U.S. election and what we do if suddenly Trump comes back with a force and is going again on his U.S. against the world rhetoric. So there's so many things that I still need an answer to, or at least like a direction that I feel is like very hard to say like, okay, we reach this point and then the market goes up or down.
JP, I hear what you're saying, and there's huge amounts of uncertainty, but to Heather's point, I'm not seeing it anywhere in terms of market pricing. I'm not even seeing it in the options market when it comes to equity in terms of hedging some of that risk. So where am I looking for signs that there is uncertainty? Because at the moment, if I looked at the equity market in particular, I wouldn't see any uncertainty. I would only see certainty. But I find it hard to believe that there is that much certainty.
I fully agree. I would even say like I disagree that there's so much certainty and so much positivity for markets. The thing is like we have to make a very deep distinction here between what the market is pricing and for what reason and what is actually happening. So what the market is pricing is a lot of technical stuff. We have this huge amount of option sellers that are keeping volatility depressed. We have systematic buyers in the market that are still moving stocks higher. And we have a lot of like, let's say, the classic investor who stood at the sideline for a huge part of the rally is now jumping the ship. So all that said is like you get this impression or this artificial impression that everything is sound in the market. But if you look at the VIX, for example, the VIX at 13 points, this is like near the average of the 2010 years, right? Where like everything was really like Goldilocks and everything was good and fine in the aftermath of the global financial crisis. Yeah. And I would argue we would need to see the VIX rather at the level of, let's say, 20-ish, something like last year in the midst of the Ukraine grain crisis, etc. But it's very hard to price this for a market with all these mechanical forces around. So looking for uncertainty in the market is basically impossible. You need to look at the headlines and the fundamentals to get to that view.
Heather, did the back end of last year do us any favors? We had this massive rally. Bonds went up, equities went up. Has it created a really tough starting point for 2024? We've got this year that has this huge amounts of uncertainty, yet 2023's parting gift to us was a massive rally that now leaves us in a position that is really difficult to deal with.
Yeah, I think, markets got over-enthusiastic. I mean, and there was a note out today that long-term rate cuts tend to not be great for stocks because often central banks like the Fed cut rates because there's a recession.
Yeah.
We still haven't, we're still in this Goldilocks scenario. I think the rate cut bets, the soft producer prices this week ramped them up, but the core consumer price index showed that inflation is still sticky because of services. We've seen a couple profit warnings come out, like in the luxury industry with Burberry.
Yep.
I think things like that are really going to move the dial. As JP said, it's going to come down to headlines and fundamentals. And in the next couple weeks, one thing I'll be watching is what kind of outlooks are companies getting. I mean, last quarter you saw some big bellwethers like Caterpillar's, great results, but saying, okay, we're cautious for the year ahead, and they sold off. And, we're pricing in that earnings are going to have a huge bounce back this year. If we see revisions starting to go down, going out into second, third, fourth quarter, that is also going to maybe kind of punch a hole in this Goldilocks scenario.
JP, what do you think? Do you think it's going to be, what are we going to be looking for in this earnings season? Is it going to be that growth is slowing or that inflation is remaining elevated? I'm hearing CEO after CEO coming out of Davos right now talking about the fact that they still see elevated inflation.
Yeah, definitely. I mean, we need to look at inflation in two ways: the producer inflation and then the consumer inflation. And the big question is like, okay, will the producer inflation go down as well as the consumer inflation? And how much pricing power is left for corporations? We saw that pricing power already fading the last quarter and even the quarter before, I would argue. Again, we're seeing like revisions to the point that Heather just touched already, like going down slightly. And now the question is like, what is the market doing with that? On the one hand, of course, you lower the bar, it's easier to jump it, and then we are like at the end of the earnings season again saying like, okay, like massive rally because everybody jumped the low bar. That is one scenario that is probably very likely that could happen. On the other hand, like again, it feeds to the question is like, at which point will we get clarity? And I guess like we need another at least 2 earnings season, I would say, like to really like build up that picture of like how well are doing corporations, especially here in Europe. How will the recession look like? How will the earnings recession look like? And especially how will the consumer behave throughout the year?
I tell you what, you keep an eye on what's happening with wages right now. You're hearing that on both sides of the Atlantic. Guys, we're going to leave it there. Thank you very much indeed. JP, thank you very much indeed. Heather, thank you very much indeed. We're going to get more insight into our question of the day. Is the outlook for 2024 becoming any clearer? Themistocleos, UBS Wealth Management CIO EMEA, joining us next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Continuing coverage this week, only on Bloomberg Television and Radio.
We are not very optimistic when it comes to returns this year and the next few years, actually. And if we start with rates internationally, I do not see them coming down as fast as many other people. I think we have some underlying inflationary pressures. We've got wages now, wage demand really high in a lot of countries, and so that could lead to some, spiraling of inflation going forwards.
Nicolai Tangen, the Norges Bank Investment Management CEO, the Norway Sovereign Wealth Fund, speaking to Francine a little bit earlier at the World Economic Forum in Davos, Switzerland, talking about the idea that he doesn't see substantial returns over the next few years, talking about the fact that the market is over its skis when it comes to the anticipation of rate cuts. Takes us back to our question of the day. Is the outlook for 2024 becoming brighter, clearer, or maybe a little bit more murky? Joining us now, Themis Themistokleos, CIO EMEA at UBS Wealth Management. Nicolai doesn't expect big returns. He thinks the market is over its skis in terms of anticipating rate cuts. Those were the basic ingredients in terms of what was driving the rally at the back end of last year. Coming into 2024, that was the narrative. Do you think we're 15 days in, do you think we've got a better idea of what 2024 is going to look like than we did at the beginning of the year?
Done a month ago. I'm not sure there's much that changed over the last few weeks. And I'm not sure we're going to get clarity anytime soon, to be honest, because if the biggest question is about rate cuts, then we need to get more data on inflation. And inflation, we know is coming down fast, but it's going to take a while before we get the comfort.
Are you sure about that? Because that's one of the biggest questions that I think I'm hearing out of Davos this week is that there is a number of very senior investment people and a lot of CEOs saying we don't see inflation coming down very rapidly. Is the market too advanced in its thinking on inflation?
Well, if we look at the latest data, run rate over the last 3 months, we're talking about PC below 2%, right? So if you look at the data, it's telling us that inflation is coming down. Core inflation, the U.S. data, the headline inflation went up a little bit because of base effects, but then core inflation continues to come down. Similar picture in Europe. Now, the question, I suppose, is when would we hit the target for central banks, which is around 2%? And we have to remember that central banks need to see inflation hitting their target in their forecast period, not when they start cutting rates. So they will start cutting rates before inflation hits their target. Now, I suppose if you look at risks around the expectations for rate cuts, is if at some stage during the year we have a much stronger economy and then inflation, goods inflation, for example, starts to pick up again. Goods inflation has been one of the biggest drivers for inflation coming down. Services inflation is also been coming down, but a bit more slowly. So I think the trend, I would be surprised if people disagree that the trend is down. The pace of that, you can disagree. You can say maybe it will come down a bit slower.
That all sounds very nice. Inflation comes down. We'll see how it comes down, and we can cut rates as it comes down. But if you take a step back and you look at what's being priced right now, 6 rate cuts from the ECB, 6 rate cuts from that sounds like an economic catastrophe response rather than a inflation's dropping a bit, we can keep real rates tight, but we can still cut rates in that process.
And I would agree with the view that maybe the market is gone too far. If I look at the US, we're looking around 4 cuts for the current year.
Yep.
In Europe, we're looking at the rate of rate cuts. And I know there's 2 camps when you look at the central banks cutting rates. One camp says, well, inflation is close to target. Why shouldn't the central banks cut and proactively avoid recession?
Yep.
There's another camp that says, well, if the growth is strong, inflation is coming down, why should the central banks cut rates? Well, I suppose we are somewhere in between, that we think inflation is coming down, but central banks would make sure that they don't cut too far, too soon, and then allow inflation to pick up again.
When you talk to clients, when they come to you and ask you questions, how do you convince them that the strategy that you're proposing is the right one? And how difficult do you think it's going to be to keep them on track this year? 2024 looks like a really bumpy, difficult to navigate, hard to get clarity kind of a year. And even if I'm right, even if you're right, at some point you're probably going to be wrong this year. How easy is it going to be to keep the kind of the focus on what is happening?
I think the key to it is to keep looking out, let's say 12 months, to the end of the year. Because what's going to happen in the next week or the week after, there can be a whole lot of volatility that can be induced by geopolitics, can be induced by noisy data, whatever. So if we look a year out, is inflation on the way down? Yes. Would central banks keep cutting rates? Yes. How many? We can debate, but the trend is down. And then you look at across the different asset classes, and what returns can you expect a year from now if our scenario plays out? And if we look across the different asset classes, we actually expect reasonable returns in equities, in bonds, in alternatives. So we're talking, 8 to 10% return. So that's a decent return. Yes, you can get, 4% out of cash, but you can get out of a balanced portfolio, you can actually get pretty decent.
Do you think the risk, that 4% spread, is worth it? Do you think the spread between my 4% here and the risk of maybe things not turning out right on the upside is worth it right now?
Absolutely, because you've got to consider 2 things. Is what you get the spread on cash, but also is the investment risk, because as rates come down, when your cash comes out of that fixed deposit, then what would the market look like when you look to reinvest? By that time, the market might have rallied, and then you run a huge amount of reinvestment risk. So having a balanced portfolio, we think, makes a lot of sense.
Demis, great to see you. Thanks for stopping by to see us. Demis Themistokleos of UBS Wealth Management. We've got some breaking news. The US Secretary of Defense, Lloyd Austin, has been released from hospital. He was hospitalized on January the 1st, complications from prostate surgery. Austin to perform his duties remotely, we understand, according to the latest reporting, for a period of time. Clearly, there's still questions surrounding the communication breakdown that maybe existed between the White House and the DOD. Anyway, what are we going to talk about next? Thousands of angry farmers protesting in Berlin today. They've largely gone home, but Germany narrow escaping a recession. That's what the data showed us today. How do we connect these 2 stories? We'll talk about that next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
Inflation is a greedy beast, could be a very stubborn phenomenon. So we should be more stubborn on the central bank side, and we should avoid a mistake to cut too early. This was often a mistake that was done in the past, and I don't want to repeat this mistake.
Nagel does not want to be Burns. That was, of course, Joachim Nagel, the president of the Bundesbank and member, obviously, of the governing council of the ECB, speaking earlier to Bloomberg Television at the World Economic Forum in Davos. He sounds cautious. Meanwhile, back home, thousands of angry farmers descending on Berlin today with their tractors, loudly booing a government minister. It rounds off a week of nationwide protests against government plans to cut subsidies to the agricultural sector. Let's go back to Berlin. Bloomberg's Ollie Crook standing by for us. Ollie, talk us through why we're seeing this protest and how it connects to what is happening elsewhere in Germany. The tractors I see over your shoulder are still there. The tractors are there because of fuel subsidies, but is that the same story as what is happening on the Deutsche Bahn with the strikes there? Is that the same story as what we're seeing in the east of Germany with the AfD? Why is Germany so upset right now?
I mean, ultimately, you're going to have to draw some of the connections between all of these things, and it's really against the sort of backdrop of the economy that is really struggling here in Germany. And again, Guy, we've talked about this for months and months and months. There's the question about the sick man of Europe. The reality of the situation is you had a year of contraction last year in Germany. It is the only developed market like Germany to have contracted last year. There's some major questions about will there be any growth this year? And if there is going to be growth this year, it's going to be something, a couple dozen basis points here and there. So that's not really going to take us forward. And the reality of the situation is that constitutional court ruling basically made go away 60 billion euros that were going to help finance some of the difficult decisions that this government had to make that now they can no longer. And so that has caused problems within the coalition because guess what? 60 billion euros can paper over a lot of issues. And when that goes away, you start to see where the actual trade-offs need to be made.
What? But okay, so farmers are protesting because their diesel is going to be more expensive. But on the other hand, if I was analysing a company, I'd say, yeah, but you guys have got pricing power. Food prices have gone up massively. Why is there a problem here? Can't you afford that extra fuel input cost?
Well, again, this is some of the arguments that also, that more rationally are made. This is what Lindner came out and said, hey, listen, you have 9 billion euros worth of subsidies from Brussels and from Berlin, and that over the sort of next few years, because of course they've dialed back some of these measures, this fuel tax is only going to cost you, about 300 million of all of those numbers. But again, I don't think it's just about the sort of dollars and cents. This is about a sense more broadly that there is within this part of the population, within the farmers, and it wasn't just farmers out there. It was truckers. I spoke to some nurses. I spoke to people in the construction industry that they really feel that there is a sort of disconnect between the people in Berlin and what they're feeling on the ground and their economic reality.
Ollie, great coverage today. Really enjoyed it. Thank you very much indeed. Oliver Crook joining us in Berlin. We're nearly done with the market day here in Europe. Let me just show you some of the 52-week highs, 52-week lows. Actually, I'm going to show you the lows. Volvo Cars continuing to have problems. That stock down by nearly 6% again today. The reason for it is having supply chain problems related to what is happening with the Red Sea. Remi's down today. Wacker Chemie is down as well. The chemical sector remains under significant pressure in Europe. That's a useful lead indicator. HelloFresh down on a downgrade. That stock down by 4%. Talking of downgrades, HSBC under pressure today. This after BNP Paribas analyst Guy Stebbings cut the stock to underperform from neutral. He's lowered the price target as well. Stebbings basically thinks the risk to the bank's margins are underappreciated by the market. he sees the lender reducing the amount of returns it delivers back to shareholders. L'Oreal has also been under pressure as well. In fact, one of the biggest point drags on the CAC 40. UBS downgrading that stock to neutral. This after a period of outperformance, you could argue, versus the sector. So we're seeing UBS downgrading L'Oreal. You're seeing HSBC downgraded by BNP Paribas Exane. Those two stocks are really weighing on the CAC 40 and the FTSE 100 respectively. These are heavyweight stocks which are having a really big impact. Now, take a step back. Put these kinds of moves aside. Actually, I don't think you're getting much price action today that is worth taking away with you. We're waiting for the US return tomorrow. But it's interesting to see some of these upgrades, downgrades on big stocks having really quite a big impact on a day like today. Anyway, the market close is coming up next. We'll deal with some of the other details that'll be moving these markets as well. That's next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Was going to keep Real World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
So we're wrapping up this Monday. Feels like a fairly depressing Monday. The US is on holiday. There's not much really happening in European markets. Markets being dragged a little lower by some of the analyst calls today on single stocks. CAC 40's under a little bit of pressure because L'Oreal's being weighed down. The FTSE 100's down. HSBC is under a bit of pressure. BNP Paribas Exane dropping that stock. DAX is down by around 0.5%. The data out of Germany aren't particularly good. You can argue they're not as bad as you would have thought they maybe should be, given the number of rate hikes that we've seen affecting affecting that market and what's going on in China, etc. So kind of a bit of a status quo day, really, today. We'll wait and see what happens tomorrow. I think you'll get a better price signal. This is what the session has looked like. Again, not really, I don't think, giving you much kind of a sense of direction. I think we've kind of left to right, we've dipped a little bit, 0.5%, 474. But these are still relatively elevated. Take a look at the longer-term chart, relatively elevated markets. Single stocks, there's a bunch of them that are probably worth looking at. As I say, there's been some racing moves today. Just Eat is certainly one of those that's been impacted. Dassault, this is, I hope that's Dassault Aviation. It might not be. Dassault down on the back of lower deliveries. Remember, they make BizJets and the Rafale fighter jet, and HSBC. There you go. That's the downgrade we got from BNP Paribas Exane. Let's talk about the rest of the week, because things are going to warm up a little bit. We've obviously got the World Economic Forum continuing, some great interviews coming out of there. My initial takeaway so far is that certainly the leaders I've been listening to are unconvinced that inflation is going to come down as easily as maybe the markets are pricing. Euro area industrial production data, I think we've already had that. We've definitely had that. Wasn't that great. I think it was the third time it was down. US bank earnings are going to continue as well. Jobless data out of the UK, Germany CPI. CPI is going to be a theme throughout this week. GDP data out of China. We're going to get retail sales and industrial production as well. Euro area CPI. I think we get... I'm trying to work out what the order is here and make sure we've got it all right. Anyway, let's just go with that. Beige book out of the US on Wednesday, and UK industrial production. UK CPI, housing data. Lagarde speaks. Georgieva speaks. There's a lot going on there, but let's dig into some of it and deal with what we've got. ECB inflation expectations are maybe a little bit stickier. I've heard today from Joachim Nagel. He's unconvinced about what is happening in terms of the inflation story and how easily it is going to get to bring that down. Out of Austria, you've got Holtzmann talking about the fact that there may not even be a need for rate cuts this year. I think you had Philip Lane over the weekend, certainly pointing to the summer for the first rate cuts to be delivered by the ECB. Simon French, Chief Economist at Panmure Gordon, joins us now. What do you think? What do you think about the idea that the ECB is going to cut 6 times this year?
Well, I think the market's wrong. I think that's too aggressive. I actually think it's wrong across the piece, because I tend to share your view that inflation we've moved through in developed markets through peak base effects in terms of the negative downdraft from particularly energy. You've got a bit more to come from food, but actually it starts to level off. You start to see the underlying core wage pressures. But ultimately, we're still in a market where central banks are trying to manage financial conditions, not allow them to loosen too much. They're going to try and lean back in against this. I think what we've also got is a situation where if you look at the spread in European economies, particularly in the Eurozone, there was quite a narrow spread of economic outcomes about 12 months ago, the start of 2023. By my proprietary data, you've got quite a big spread now between Europe's strongest performing economy, Poland, and its weakest, Germany. How do you possibly set a single bank rate for that bifurcation in economic trajectory?
I'm not sure the ECB is going to be focused that much on Poland, but...
Well, no, but I mean, it's a broader piece of the European economy responding. I think
still doing okay.
It's a fair challenge, but you've got also Spain, which is second behind Poland, so within the Eurozone. But you've got that spread now of economic responses to tighter financial conditions and also exposure to big export markets, China, meaning that a single monetary policy and also an inflection in that monetary policy won't be appropriate, whatever timeline they choose in 2024.
It's going to be a difficult job. You talked about the easing of financial conditions that we've seen thus far. The UK is a really interesting example right now. I saw the housing market data this morning. You're seeing a re-acceleration in the housing market. This comes as we've seen swaps feed into mortgage rates, which are now feeding into demand for housing once again. How are central banks going to be looking at that easing of financial conditions we saw at the back end of last year, and how is it going to affect their thinking, do you think, as they look at the potential for housing to take off? That's really cyclical, but employs a lot of people, is going to drive wages and jobs and everything else. How do they look at the financial conditions, the easing that's already in the system, the effect that it's having, and wonder whether or not, actually, if they deliver that kind of easing, whether or not inflation could take off again. They are terrified of being burns.
They are, and I think what we know, well, certainly central bankers here in the UK know, is that there is still some impulse to come from the tightening they've already done, for the fact that the UK mortgage book, it's about a £1.6 trillion mortgage book, about 70% of UK GDP. It's got an average interest rate of 3.2% at the moment.
Yep.
Now, even with forward swaps coming down, we're seeing some deals actually priced below 4 for the first time in a long time, certainly since the mini budget of September 2022. But you've still got, even if you're refinancing at 3.95, you're coming off deals at 2% in many cases that were done pre-pandemic. So you still have some tightening. I think what we've just seen is the incremental scale of that tightening has pulled back quite considerably since the Bank of England last did a monetary policy report back in November. So I expect what we'll see in February, 1st of February, their next monetary policy report, their next update to their economic forecasts, you see that quite considerable easing in financial conditions passing through to a quite considerable upgrade in growth. Bank of England sees zero growth for 2024. I expect they'll upgrade by 50 basis points on the 1st of February.
So how does that affect timing around policy? How does that... Why... Doesn't that just give them more time? Doesn't that give all of these central banks more time? They've had this easing in the system. Doesn't it give them more time to push out any rate cuts that are going to be delivered in order to maintain real tightness, but with inflation coming down, they can do that with lower rates? Just walk me through the timing around all of this.
Well, so I think you and I agree. The quizzical part is why a bond market's so...
They're pricing in really bad economic outcomes.
They are. And I get there's perhaps a philosophical debate to the degree to which I don't know an awful lot of economists that expect 6 rate cuts in the euro area or indeed 5-4 in the US. I don't know many of that. The degree to which those likelihood markets are a pure play on what market expectations are, or whether they're a hedging device to tail risk of a very hard economic landing. And maybe we perhaps put them up on too much of a pedestal, those likelihood estimates, which, if we'd gone back 12 months, they were also seeing rate cuts to the end of 2023, which didn't actually crystallise in any major geography. So those likelihood markets can be wrong. I think we're just concluding they're wrong again.
The problem with that is that we price everything off these things.
Well, of course we do,
And as a result of which you get a positive effect, particularly in the States, it's a wealth effect that comes off equities. It's a wealth effect that comes off financial markets, and that therefore feeds back into this idea that the consumer is in better shape and can continue to spend, which continues to support particularly the service side of the economy, which means that inflation doesn't come down as quickly. So it's a really difficult situation for central banks to find themselves in, particularly the Fed, that there is a danger that it doesn't see a slowing, that it sees a re-acceleration, that the cyclical parts of the economy start taking off again, like housing, and the non-cyclical bits, like the service sector, actually just continue to do just fine. That's a recipe for an economy that's not landing, it's taking off again. At the beginning of this year, we thought we were landing. Now there's a danger, maybe the economic data is pointing to a stronger economy, not a weaker economy, as you just mentioned with the Bank of England.
So this is where I was about to say where central bankers earn their salaries. Actually, it's more likely they earn their speaking fees after they've left central banking. But I think there's a broader point here, which is at inflection points in the cycle where you get not just two-stage economic zones, as we talked about in Europe, but different speed sectors as well, is how do you balance that all up together? I think it's a particular acuteness in the UK given the outsized scale of the housing market, which is, in the residential terms, it's 3.5 times as market capitalization of our domestic equity market. It's only 1 for 1 in the US. So if you're seeing that housing amplification through expectations, the rates come down, crystallizing through in offered debt markets, you actually get an outsized impulse into the economy, which you have to try and balance up against the fact that industrial production, you mentioned across Europe, industrial production in the UK, soft, PMIs widely in the manufacturing sector, below 50. But even that's not a pure indicator of economic...
And those have bottomed out, and they're starting to accelerate again on the upside.
They have, but you also have to weigh it up against the services sector, which is still in pockets very, very strong. Travel, hospitality, still a lot of pent-up demand. You haven't got a stable demand picture here. You still have some, it feels a long way fortunately, in the past, the pandemic. But some of those consumer behaviours of what they're consuming, air pockets in durable good demand, allowing some of those classic indicators which market participants look at, manufacturing PMIs as an indicator of what central banks will do, they may not be great indicators in this cycle.
Well, that sector's been predicting a big recession for a while. You could argue maybe it's been in it, but it hasn't been a useful indicator for the rest of the wider economy. Simon, always a pleasure. Thank you very much. Simon Fredge, Panmure Gordon. European stocks done for the day. Let's just wrap it up. Price signal today, not very useful. US markets are out for the day, as a result of which I think you'll get a better price signal tomorrow. Single stocks have actually had quite a big effect today. HSBC's been down on a downgrade for the FTSE 100. The CAC 40's been down on a L'Oreal downgrade. The DAX, more mixed. Anyway, we are done for the day. We'll see what happens first thing tomorrow morning. What are we going to talk about next? Well, certainly one of the wild cards of this year is going to be US politics. Iowa Republicans preparing to decide who they want to take on Joe Biden in the next presidential election. Look at the weather. This could have a big effect in Des Moines. We'll talk about this next. This is Bloomberg.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
So let's turn to politics. In the United States, Republican and presidential hopefuls facing their first test this evening as Iowa holds the first GOP caucus of the election season. The biggest test may be the weather. Freezing temperatures and snowy conditions may have an impact on turnout. Bloomberg's Kaylee Lines joins us now. inside but on the ground, close enough to the cold to very much be within touching distance of what is going on outside. Okay, let's first of all deal with the weather. How big an impact could it have? I understand it's absolutely freezing where you are.
It is well below freezing, in fact. I'm going to speak in Fahrenheit, Guy, because I don't know the conversion to Celsius, but it is right now about 10 below in Fahrenheit terms, and the wind chill is closer to negative 30 degrees Fahrenheit. So it is very, very cold out there, and as you can see behind me, there's still a lot of snow. The roads are a little bit icy, and the head of the Iowa Republican Party was actually here in our pseudo offices at Bloomberg yesterday, and he says his primary concern in terms of turnout is actually the ice, because that is what will affect people's ability to leave their homes and go out and caucus at 7 p.m. Central this evening. He doesn't think the temperature is going to be what turns Iowans off. We've heard they're a pretty hardy bunch when it comes to that, but just the ability to get to their caucus locations is the primary concern. And for these different candidates, they have different degrees of ground game here. Of course, Donald Trump, the former president, remains far and away the front runner here. The latest polling from the Des Moines Register and NBC has him at 48% support. And there is a question as to whether or not that means that people may think he has this in the bag and they don't actually need to go out and caucus for him. So that remains a question. And for Governor Ron DeSantis, who currently is third in that latest polling at 16% below Nikki Haley by about 4 points, he does have a pretty strong ground game here in Iowa. He's been to all 99 counties. They have a lot of volunteers and workers ready to go to the caucuses tonight. And he thinks, his campaign thinks that may be something that actually helps him out with weather like this, that they will actually turn out for him because his ground game has been so strong.
Kelly, thank you very much indeed. Kelly Lyons in Iowa. Some great coverage coming up there, I absolutely assure you. Sticking with politics, we spoke a little earlier to the US Vice President Al Gore at the World Economic Forum annual meeting in Davos, Switzerland. Francine asked him about some of the biggest global issues he sees on the horizon.
The time has come to reform this process. The world is getting understandably impatient and frustrated that these conferences are rigged. They're rigged. The deck is stacked in favor of the fossil fuel industry.
But we did have agreements. So again, how do you match the two?
Such as they are. There's so many loopholes and so many tricky phrases. And it took 28 COPs, 28 years of COPs before we even could use the phrase fossil fuels. The climate crisis is a fossil fuel crisis. That's what it is. And yet it's taken us this long to overcome their resistance and even naming the problem.
What happens to climate change pledges from the U.S. if President Trump has a second term?
Well, first of all, let me say that I think that in spite of the loopholes I mentioned in this agreement, and in spite of the frustration many of the climate advocates, such as I, have felt about it, nevertheless, we see the direction of travel, as they use that phrase, for both business and government, shifting inexorably toward low-carbon, renewable energy, and toward net zero. We see the same thing here at the World Economic Forum. This place is sometimes criticized. It's unique in bringing all kinds of people together in a way that doesn't happen anywhere else. And your question was?
If President Trump gets into the White House, what does that mean?
First of all, I of course hope that doesn't happen. There are many of my fellow Americans who are for him. You know, look at the last time when he became president, we continued the march toward renewable energy.
On the business side.
On the business side, and state governments continued to pursue carbon reduction. Here in Davos, a Republican red state governor from Georgia is leading off talking about the virtues of electric vehicles. We are seeing with the legislation that President Biden got passed, the Inflation Reduction Act, as it's called, the biggest climate legislation any nation's ever passed in history. We're seeing a change in the political realities on the ground in the U.S. with the creation of tens of thousands of new jobs in electric vehicles, batteries, wind, solar, efficiency, green hydrogen, and now some of these red states in particular, they're now seeing the benefits of all these new jobs being created. It's really changing the reality.
Do you think Donald Trump won't try and touch that?
I wouldn't even begin to predict what goes on in his calculations. And of course, tonight we will see the results of the first contest, which all the pundits tell us he's likely to win. But in New Hampshire, it could be a different story.
Former US VP Al Gore speaking a little earlier to Bloomberg's Francine Lacroix at the World Economic Forum in Davos. What are we going to talk about next? Bank earnings continue. What should we be expecting from Goldman Sachs and Morgan Stanley after what we learned at the tail end of last week? We're going to find out next. This is Bloomberg.
All this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going, through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time where we'll be fully transparent on viewing data.
So big banks in the United States started reporting their earnings last week, Friday. We're going to start that process again tomorrow. Goldman Sachs, Morgan Stanley releasing their latest numbers. Clearly, we'll be looking forward to the spin coming out of Davos as all the CEOs arrive and tell everybody what they really should have thought about these numbers. Jenny Serene joins us now. She leads our coverage of what is happening here. Friday, JP Morgan, Citi, etc. Some really idiosyncratic factors, maybe you could argue, impacting their results. Therefore, how useful a guide are they for what we get tomorrow in GS and Morgan Stanley?
Yeah, no, you're definitely right that kind of every bank out there has probably some one-off items that they needed to deal with. But certainly across the board on Friday, we did not see that long-awaited rebound in investment banking really materialize in the fourth quarter results. And that's really what Goldman Sachs and Morgan Stanley are known for. So we're expecting, more of the same tomorrow in terms of deal-making being on the back foot. Capital markets really haven't revived. Trading was also a lot softer in the fourth quarter than I think most bankers were expecting. So probably not a ton of good news to come out of the results tomorrow.
You could argue if you were starting out at Morgan Stanley as the new CEO, that might be exactly what you would want to hear.
I think, coming off of a low base is always a fun place to start from, but I don't think anybody's really hoping for more of these doldrums that we've been seeing in these past few quarters. And really, what we heard for so much of last year from these bank CEOs was that, the fourth quarter, the second half, that was going to be when things turned around, and we never really saw that materialize. So I think the question that a lot of these guys tomorrow will be answering is, does that come to fruition this year? What does it take to get these things back up and running? Especially when you had those banks on Friday, they all have these really big consumer units to kind of fall back on when times in investment banking and trading don't look so good. Goldman Sachs and Morgan Stanley really don't have that. So I think a lot of investors are really going to be questioning, where will the earnings growth come from this year?
I continue to be surprised. There have been some layoffs, but not an enormous amount of layoffs.
That's right.
If we continue with these kinds of numbers, does that become a more difficult argument to sustain?
I think so. I mean, so on Friday we heard from Citigroup saying that they are going to be cutting 20,000 jobs over the next 2 years. And so I think we're going to start hearing some of those bigger numbers finally come out. But again, 2 years is a big time horizon for those kinds of cuts. And so, they might have time to change their minds if things really get better. So we'll see. I don't know that we're going to be hearing anything that drastic from these banks tomorrow, but certainly if things kind of continue the way they have, that becomes a more real reality.
What's happening on the asset management front, particularly for Morgan Stanley?
Yeah, that's a good question. I think that's another area that was really weak in the last year or so. It's really driven a lot by what the markets do. And so if you start to see equity markets really turn around and things really power forward, then that should look a lot better for them. But you've seen them make a really big bet here. Yeah. Ted Pick is, from a different part of the business. And so I think he's going to be getting up to speed and probably wanting to answer really quickly, what he sees as the future for Morgan Stanley.
In terms of the macro read from the consumer side was kind of a bit more clear. Is there a macro read to come off these guys?
No, it's a good question. I mean, I do think what the consumer does in the U.S. drives so much of what corporates end up doing. And so they definitely feed into each other. But unlike what we have with J.P. Morgan or Bank of America, where you can directly see, are consumers keeping up with their mortgage payments or are they keeping up with their credit cards? We don't have that as much. But you do see it in the read across. If Walmart doesn't see consumer spending, they're not going to go out and do deals. And then that's where you see, Goldman Sachs and Morgan Stanley coming in. So you can kind of see it in that, but you don't have as much of an easy read through to the U.S. economy as you do with the guys on Friday.
The continuation of a theme is that the big get bigger. Are we going to continue to see that in this set of numbers?
It'll be a good question. Certainly there wasn't any major shakeups last year in terms of who was at the top of the league tables. I mean, the big shakeup was that those league tables were just measuring such a smaller amount of deal activity. So I don't think we're going to see anything too crazy, and I don't think you're going to see any of the big banks really committing to doing big deals anytime soon to even get bigger from here. But we'll see. I mean, you've got Ted Pick, to your point, coming in, trying to make his mark on Morgan Stanley, so we might see something really exciting.
Big shoes to fill. Jenny,
absolutely.
We're going to look forward to the coverage. It's been great so far. It will continue to be great, I'm sure. Jenny Serrain, in-depth coverage of the IO caucuses as well is something you're going to want to pay attention to. We've got some great coverage coming up of that. We're going to start that coverage at 5 p.m. New York time. Look at the weather. It's a little chilly in Des Moines. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, But I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested, they want to be an early adopter of the stock, they're interested in the story.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
If I can have everybody answer the same question, what do you come to work to do every day? And the answer to that is because we're the custodians and we're responsible for the savings and the pensions of real people like my mum and dad and your mum and dad, then we do a better job every day.
It's the world's largest listed hedge fund manager. And after 240 years in existence, Man Group has a woman in charge for the very first time. Robin Grew was promoted from president to chief executive last September, the high point of a 15-year career at the firm. The former barrister entered the world of finance 3 decades ago and never left.
The speed of change, the impact, the global nature, the challenge of it just never stopped getting more and more infectious for me.
In this episode of Leaders with Lacroix, I speak to Robin Grew about diversity, purpose, and what the future holds in an ever-changing world. Robin Grew, thank you so much for joining us on Leaders. The world is a bit strange. There are so many polycrises, or whatever you want to call it. It's just difficult to get a handle of what comes next.
Yes, that would be the shortest answer I could ever give. Yes, it is difficult. I think that if this year has taught us anything, it's that prediction is not our strongest suit, perhaps. And that isn't just in relation to markets, it's in relation to these big geopolitical events that we are still living with.
But it's quite incredible to think that we're in a better place than we thought. I feel like every 6 months, there's like the doom and gloom crew saying, this is it, interest rates have gone too much, we need to reevaluate what happens next. And yet, the economy holds.
I think that's right. I think when we talk about it and we have this conversation about higher for longer, which I still say out loud, and then cross my fingers in some ways that maybe I'm going to be entirely wrong, but higher for longer. I think where the nuance is in that message is that what we're unlikely to see is 0%. We're probably unlikely to see 2%. We may see some 50 basis points adjustments, for sure. But I think what we have been signalled clearly from central banks is that they're not frightened of using policy to control inflation or to try and respond to inflation. And I think that's the messaging we should all kind of get used to. Last 10 years, 0% free money. Next 10 years, higher for longer, with that slight nuance in the way that I described.
And I imagine that 2024 could be difficult because of volatility and
dispersion.
And
yes.
So it makes it harder actually to manage money.
I think it does. And I think the denomination effect that we saw because of the kind of the hiccups in the system with the banking crisis or with LDI, that also put a premium back into liquidity. So what's your duration risk? What's your liquidity risk? How do you manage through these different economic cycles? And are you prepared or are you ready for hedging, which means that, let's remember what that means. It means that at times you're going to do well and at times you're not going to do well with the entirety of your portfolio. And that's okay, that actually managing your portfolio for these different changing economic cycles or behaviors is what you're supposed to be doing.
Does it change how you lead Man Group?
It changes because of the way that we position the organisation. We are an organisation that is diverse. Our capabilities are diverse. We have different engines doing different things, be it in the quant side or on that fundamental discretionary side. We have products that are in the macro space, products that are in equities. We are long only, we are long short. But what we are seeing is our clients are interested in more customised solutions, in solutions that actually answer the problem they've got or the challenge they have, rather than here's a product, you buy that or nothing else. So it changes in the way that you deliver an organisation. It changes in the fact that the value you're driving towards is not just about here's a product, but it's here's a solution.
So what does it mean in how you're focusing your energy on in 2024? I know you want to be in the private credit space,
yep.
But I guess hiring is also something that you need to think of carefully.
We don't make widgets. What we have are highly talented individuals who are focused on being the very best they can be in the workplace and delivering what they do. And that can be alpha in our engines, or it can be in our operations and middle office department, or it can be in our legal department. It's about a war on talent. So hiring the very best people, retaining, keeping those people, giving them opportunity, giving them a space where they can be the very best they can be is incredibly important. So it's tech, it's talent, it's vision. It's about knowing that when people come to work every day, every single person at Man Group adds value and is valued. That's important. It's that moment. If I can have everybody answer the same question, what do you come to work to do every day? And the answer to that is because we're the custodians and we're responsible for the savings and the pensions of real people like my mum and dad and your mum and dad, then we do a better job every day.
So how do you hire? Again, there's a war on talent, or
yep.
there's a battle to get the very best.
Yeah.
So what do they want?
They want, so depends. I think that's the one size doesn't fit all thing. Who doesn't want to be around really smart people? Number one. Who doesn't want to be around a place which values your input? Who doesn't want to be in a place that doesn't seek to be better today than it was yesterday and better tomorrow than it is today? Who doesn't want to be around a place which is actually interested in you as a person and interested in being capable of making you better? So where do we go? We go broad, we go wide, we look for difference, we look for energy and excitement, that person who's able to get energized.
You don't always hear that from a big finance chief executive.
Okay, I'm not
Is there a
apologizing.
perception problem for finance?
I think finance hasn't done as good a job as we might in explaining the value we bring to society more generally. I don't cure cancer. That's not what I do. I wish I could. I mean, I wish I was that smart and capable to do that. But what we do is protect and enrich the savings and the pensions of people who've worked incredibly hard all of their lives and diligently put their money aside in their 401k or wherever it may be. And we're entrusted with that, and we can give them, if we do our job well, financial security. We can provide something that enables legacy investing. It enables access to healthcare, to education, to a roof over your head, to pay the bills, to all of those things. That's a pretty important thing to do.
I mean, it's amazing. You seem to be filled with a big sense of purpose, which you don't often get from hedge fund managers.
I have a big sense of purpose. I run a firm that has a big sense of purpose, and I think that energy is something we should put to work. When I sit down with big allocators and we talk about what it is we're both trying to do, it's the same. I think the day we forget that, and the day that I think about our numbers in the sort of the institutional size numbers that we all talk about, we lose a bit of that sense of what we're here to do properly.
Coming up, Robin Grew on adapting to change in an uncertain future.
I'm not good at predicting what the next year or the next 5 years is going to be. What we need to do is be flexible, is to understand and be dynamic, to think about the impact of markets and changes.
This is Bloomberg Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From renewed geopolitical risks to climate change, a new era for interest rates, and a different working reality, the world of finance is also adapting to change. I continue the conversation with Man Group Chief Executive, Robin Grew.
Do you worry about what the future economic, footprint looks like for the world?
So our job is to say, how do we think about what could happen? How do you stress your portfolio? How do you think about what your outcomes are today? People drawing their pensions today versus drawing their pensions 50 years from now. Man Group is 240 years old. We match the duration rather neatly of some of our clients who aren't thinking about just returns for a year from now, but are trying to think about what they're planning for 30 years from now. We're not good at predicting. I'm not good at predicting what the next year or the next 5 years is going to be. What we need to do is be flexible, is to understand and be dynamic, to think about the impact of markets and changes.
Are you more worried about geopolitics or about market functioning?
I think the fact that we've now changed geopolitics to geoeconomics is something of an impact point. So as we think about what happened when Russia invaded Ukraine and the impact on our fossil fuel pricing, or you think about the worries and concerns around supply chains post-COVID and the fact that these buffers, when you think about corporate real estate and the refinancing that is inevitable. I mean, it's not a 30-year mortgage. These are things coming up for refinance within the next, 3, 4, 5 years. That's a lot of money being put to work. And we're in an environment where we look out onto the city, office buildings are in a different place and have a different level of occupancy than we've seen before. So these are big changes. And geoeconomics, I think, and things that we have to take into consideration.
What do you worry about the most? Do you have like a ranking, or is it almost one and the same? It's just this huge transformation and change.
I think it is a transformation and change. I think that we're going to see credit markets playing a role. I don't think that's a short-term thing. I think that's a real-term thing. I think if you see lending tightening, you're going to see still a need for financing out there. But it isn't that all things are created equal. I'm a big proponent of active management. I am a big proponent of credit. But not every active manager or not every credit expert is going to be able to deliver in these environments. There is expertise and skill needed. How do I think about prioritization? I think about priorities in terms of capabilities. I think about being as skilled as we can be in data, in analytics, in tech, in credit, in multiple asset classes, and then being able to pivot those. I think that's where I think about things. But do I think about that's the number one thing I'm focusing on? I don't have the luxury of that. I think we have to think about all of these things.
I mean, are you looking at acquisitions to be in certain spaces?
We have always said that we will grow the firm organically, and we will always look for acquisitions to increase our capability on content for clients. I think what's interesting, as we completed our acquisition with a private credit manager in the US in the middle markets, I think what's interesting is that the multiples look more interesting. I think we've been talking about consolidation, right? We have been talking about consolidation since the GFC. Since the GFC. I mean, this is one of those points I'm going to perhaps want to laugh about in a few years' time from now. But I actually think as we look at the barriers to entry in this space, if we look about the cost of running our businesses, if we think about the scale that we need to operate at, I think, and the multiples that we're starting to see coming down, I think this could be an interesting time for consolidation.
But why has it been a long time coming? Is it regulation, or there was just no appetite, or it just wasn't ripe?
I think when cash is free, it softens that. I think the moment where people need to deploy at scale in liquid markets has been something that's softened. If you look at the trend has been in passive, it's been in private equity. If you think about the number of assets that no longer sit in the public domain, that's been our themes over the last 10 years. I think when private equity doesn't have quite as much cash, when that raising is harder, when lending is harder, these opportunities for niche spaces and expertise to come about, and they want scale. They need to be able to operate at scale, and having an organization that can deliver the amount of scale we've put in play, the bit that perhaps is less sexy and exciting, but that infrastructure, the ability to take businesses and grow them, that's what we do.
What do you think of the City of London? Will it lose a bit of a luster? There's a lot it can offer. Like, where do you see it in 5 years?
You're looking at you're talking to a UK-listed CEO, so I could not be more interested in UK PLC. I think we have held such an extraordinary position in financial markets and generally. So anything we can do to keep that shine, I think, is important. But competition is high. And we shouldn't, in the way that we shouldn't in our firms, sit on our hands and think that all of our history is going to count for long if we don't keep running. So I'm a great believer that we drive and continue to drive UK PLC. There is such a lot of innovation and creativity and growth here. There's such a lot of expertise that sits in these small shores. So anything we can do to keep that alive and keep it at its top game, I'm all for. But we operate as a global organisation, and I'm going to go where there is strong capability to invest, where the markets are deeper, where the clients need us to be, and where we can find opportunity. And I'm going to continue to look for that. But I'm a UK-listed CEO who can't help but want this to be great too.
Up next, Robin Grew on being a female leader in an industry traditionally dominated by men.
I am hopeful that we're going to see a better reflection of difference at the top of every organisation, be it financial services or broader than that.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Women make up less than a quarter of employees at the thousands of hedge funds and other alternative investment firms globally. They're even more of a minority in senior positions. So when Man Group appointed an all-female leadership team last year, it marked a massive shift for the company and a milestone for the industry. I continue the conversation with Robin Grew.
Robin, 240 years old.
Yes.
Man Group is, and you're
Not
the first
me.
female. You're the first female
yes.
chief executive of an institution that's at 240 years old.
Yes.
Is it, Should it have been earlier? Like, are you optimistic about the future for females in finance?
I am hopeful that we're going to see a better reflection of difference at the top of every organisation, be it financial services or broader than that. Has it been a long time coming? I can't help but say, listen, it would be terrific. It would be good to see more female CEOs before me. I hope we're going to see a lot after me. But difference is important, and I think anything that enables us to put the most talented people at the top of organisations and to lead those organisations with enthusiasm and capability is what we're after. So I'm hopeful that I'm knocking down some doors, barriers, ceilings.
I mean, the first time someone meets you, it's like the infectious energy, right, that people notice.
Yes.
Is that how you lead?
Yes. It was one of those things. I've been accused of being many things over my time, but that sort of slight Duracell bunny, ever ready to do those battery things, just keep on going. I'm a bit that. I have an enthusiasm for what we do and a passion for what we do. It is sometimes like I'm a big boom in the room, but it's something that I think is incredibly important. You don't do this job 98%. You do this job if you can. This is where my mathematicians hate me when I say anything larger than 100%, but it's 100% plus.
Were you always like that, or is
Yes.
it something that you've learned? It's just natural.
Yes, and to some extent, it's what's forged my career. That willingness and that excitement to learn and to be part of fixing things, doing things better, has been somewhat of a hallmark. I have a ridiculous enjoyment for learning and doing things. You know, I walk into any organisation or any of our offices, and in the short journey, thankfully, in London that you have from the 0 to the 5th floor, if there's somebody in the elevator with me, I'm asking 1,000 questions. You know, they kind of wait to get out of the door by the end of it in some ways. But it's that interest in what's going on and what's happening. And it's an interest in people. I fundamentally am driven by being interested in the people I work with and in the people who we're here to work for.
So you started as a criminal barrister?
I did.
And then went into finance 3 decades ago?
Yeah, something like that.
What made you switch?
The thing was this. I loved being an advocate, and perhaps I think I'm still an advocate in many ways. So what happened was I was in the criminal and the civil bar, and I thought, I'll go do this commerce thing, I thought to myself, and I will go back and become a commercial barrister. And it sucked me in, and I never went back. The speed of change, the impact, the global nature, the challenge of it just never stopped getting more and more infectious for me. And so that legal training, has it been useful? Yes. Has the advocacy thing been perhaps more useful? Probably. But it's been just the best journey.
Do you have bad days? And if you do, who do you call? Do you have a mentor?
Yes, who do you call? Ghostbusters. If I have a bad day, I've always been a half full kind of person. Yeah. Every belief I have is that you make the best out of those tough days. Of course there are tough days. Of course there are days when you're put a challenge in front of you where performance isn't great or where I feel like we could have done a better job. Those are moments where you've got to move forward. You've got to take the next step forward. And that's what I do. I think it's resilience. I think it is part and parcel of perhaps my makeup is to be resilient. Who do I turn to? I turn to friends and family, and I take a break. I take a breather, although normally not very long a breather because I just get too excited by other things. But I fill my life. I fill my life with the things that are really positive around me. I have a great family around me. I have an extraordinary wife and a son and my parents and friends, and I am enriched by that. And so that enables me to take the next step.
Do you think there's a difference being a leader in 2024 to what it was like in even 2010? You know, does leadership or chief executive jobs need to come with more of a sense of purpose and kind of morally leading?
I think that I don't know a different way of doing it than the way I do it, and that's with a sense of purpose for sure. When you speak and you are in charge of an organisation, I think it is incumbent upon leaders to be enthused and to be passionate and be engaged. I think when times are tough, when things are tricky in the world, I think it's important that you know that and that you acknowledge that in your organizations. And we have had some tough times in the world, beyond markets, in the world, for people to live their lives. We run global organizations with people who come from places that are now in war zones, or that are too close to borders where there are war zones, where the challenges have been very real post-COVID, or where the issues are being felt materially in politics. And not to acknowledge that, I think, feels inauthentic.
When you're in charge of a big organization, it's tough being close to your employees.
Yes.
How do you do that?
It's about communication. It's about being available and transparent.
Yeah.
It's about setting your stall out. Who are we? What are we? What are we here to do? And how are we going to do that? How do we do that the best we can? My view is you do it by creating extraordinary and exceptional teams that have a focus and that understand the humanity of that, and that's important. To do that, you need different people. To do that, you need to bridge, because different people come with different backgrounds and different flavors of their experience of life. It isn't an easy thing to do. It's just a thing we should do.
It's tough, right? Also, I guess, employing people that will say no to you.
Yes.
How much do you think of that? Of actually being surrounded by people that say, no, this is not a great idea.
I think it's critical. If I'm going to have people around me, their excellence needs to be something I hear. It's less likely, I mean, my executive team might get cross at me at saying this, but it's really not the most likely pool of people. My executive committee is less likely the pool of people from which the next brilliant idea is going to sprout and germinate. It's going to be levels and other people within the firm. We need to hear that, and it's important that I am seen as capable of listening and changing my position. There are times when I am going to be less willing to change my position, but having somebody who's going to come from any part of your organization to say, hey, I feel this way about this issue, and I don't think I'm being heard, is important.
Where's Robin Grew in 5 years?
Still Duracell bunnying. I'm the best answer to every battery life, but perhaps on a renewable, chargeable basis. So where am I? I hope still leading Man Group. I hope looking back on the last 5 years and thinking how I could do it even better. I hope driving things with the same passion and enthusiasm, and I hope with the same brilliant set of people around me.
Robin Grew, thank you so much.
You're very welcome. Thanks for having me.
What are some of the measures the government are working on in terms of addressing the artisanal challenges there? Oh, a host of them, but fundamentally hinge on two policy pillars. One is reformation, which is reforming the sector, licensing regime, getting them equipment for the extraction of the gold from the ore without the use of mercury. As you know, we are parties to the Minamata Convention, and therefore we respect the dictates of the Minamata Convention. And then the enforcement regime, deploying law enforcement to make sure that people are arrested and so on and so on. So we're making that effort. But my point is that, my fundamental point is exploiting these mineral resources in a sustainable manner are not mutually exclusive. Yeah. I think that they can peaceably coexist. You can exploit the resources, and several countries have done so. I don't want to mention, give examples, but I know of countries which have gone about their mining sector and their mining industry in a manner which is also protected the integrity of the environment and the climate. We can do all of that. My friend Josephine mentioned the day we'll use solar to mine and use gas and all of that. These are all very ambitious technological interventions we can rely on. And Ghana is doing just that.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried had pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
We have already lost 50% of the world's coral cover, and we are on track to lose up to 90% in the next 30 years. Coral reef is not just an animal. They actually provide the habitat for more than 25% of the marine life on Earth, and that feeds more than 1.2 billion people. They actually are so interlinked with our daily life, whether as a source of protein, the air that we breathe, and also the coastal protections. It is the experience seeing coral disappear firsthand that got me to make the final decision to make the inhospitable seafloor, to make it hospitable again for coral reefs to recover. I'm Rico Yu. I'm the co-founder and CEO of ArchiReef. I am a scientist by training, and I am a diver as well. I grew up and spent a lot of time in the countryside of Hong Kong. I only remember going into the water and stumbled into coral reefs, and I got a lot of cuts on my feet. And that's actually the first time I learned about coral reefs, because my dad then told me not to step on them. So Hong Kong used to be a coral paradise where we have a lot of coral reefs everywhere. And what happened is that as we developed our cities, we ignored what's happening in the water. Back in 2014, I've seen a small patch of coral community disappear in Hong Kong in just 2 months. And that got me to think about what's happening and if there's anything that we can do to mitigate climate change. And that is how I started research on coral restoration and eventually found a solution that we can restore the degraded seafloor. When we first started trying to restore coral reefs, we tried all the traditional methods, but eventually, just after a year, we realized that they need something that can help them to mitigate and to face sedimentation. They need something that's biocompatible. So that comes to the final idea of creating these 3D printed reef tiles that's made from clay. So in 2022, we got an investment from our investor, ADQ, which is an Abu Dhabi-based investment holding firm. And that opened the door for us to enter our new market in the Middle East. We've been able to establish our office and also our eco-engineering facility based at Kisad. And right now we are focusing our R&D in Hong Kong, whereas we're focusing in our production in Abu Dhabi.
This is where we ultimately produce our reef tiles from start to finish. Our production goes through a roughly 7-step process We start with clay being delivered to the facility, and then we need to mix that clay, make sure that it's the perfect consistency when we get it into our 3D printers, and our 3D printers then create this very delicate structure that make up the reef tiles that are then placed in the ocean at the end of its term.
What it does is that it turns sand into suitable substrate for coral reefs. This product in itself is also very porous, meaning that it can house the coral on top of the seafloor while also help them to mitigate the pressure from sedimentation. Over the last 2 years, we've been able to deploy just about 500 square meter over the geographies between Hong Kong and Abu Dhabi. Every time when we go back to the water, actually the most immediate impact that you will see is small group of marine communities that lives around the habitat. You're also able to see coral recruits, that's baby coral settling on the tile because of the structural complexity and also the fact that we're using clay as a very natural material. Each reef tile will be able to house from 6 to 10 coral fragments, and our success rate is able to secure 95% survivorship after 3 years, which is at least 4 times higher than the traditional methods. We are able to integrate different technologies into our climate solutions. So for example, we use environmental DNA as an assessment tool to quantify and measure biodiversity. We also use AI to help us to recognize the fish faces in the water and to further quantify it and to capture the impact on the water.
Over time, what we want to build is coral highways and make sure that more and more corals find a place to settle and to grow. They have a value to play in the reef tourism sector that's worth over $30 billion a year, and overall it's estimated that the coral economy is worth more than $2 trillion a year.
We want people to think about and to see what's happening in the ocean. And once people see it, we know that people actually care about it and we want to take action to protect it.
So we get to ride in an Uber with the Uber CEO.
Yeah, that'd be pretty cool.
Come along with me, Emily Chang, as I ask tech leaders of today what makes their businesses future ready for tomorrow.
You're an expert.
I put that vision out there. That actually happened the way that I wanted it to.
You're at the end of the Earth, and it's freaking cold.
I'm Cal Penn. Welcome to Getting Warmer.
Where is there money to be made in space?
Would you like to see what $20 billion buys you in the French countryside?
We have big things to come, and I can't wait to show you.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Valerie. She was 5 years old when she received chemotherapy.
Soy la mamá de Valerie. Ella fue diagnosticada en el mes de julio del 2018. Fue diagnosticada con leucemia. En noviembre del 2019 ya iba a cumplir 1 año de tratamiento. La doctora, ella decía que ya la niña estaba superando la enfermedad. O sea, estaba súper bien. La doctora me había dicho que en noviembre del 2019 estaba bien la niña.
Valerie would receive chemotherapy treatments here. at the Clínica Medical Duarte in the small border city of Cúcuta in Colombia. On January 23, 2020, doctors at the clinic gave Valerie a dose of methotrexate, a drug used to treat cancer. Less than 24 hours later, she was back in the hospital. Days later, she was dead. The drug Valerie was given, methotrexate, was made by Naprod Life Sciences, a manufacturer headquartered in India, a country that supplies 20% of the world's generic drugs. But instead of being sterile, the medicine was contaminated with bacteria and had become dangerous. In a months-long investigation, we learned this wasn't an isolated incident. Naprod's medicines have been linked to dire quality issues with almost zero consequences. This is a story of a drug maker with a dangerous track record and how it keeps selling medicine, leaving families and doctors to suffer the consequences. Methotrexate is a drug used to treat leukemia and other cancers and has been around for decades. When given as an injection, the conditions in which the drug is made are always supposed to be sterile. If the raw ingredients aren't tested adequately, if a production line isn't cleaned properly, if the water isn't filtered thoroughly, the life-saving medicine could become potentially lethal. Naprod Life Sciences plays a crucial, if sometimes unnoticed, role in the world's drug supply chain. None of its medicines are for sale in the U.S. Instead, it mostly sells directly to suppliers in low-income countries. Batches of the cancer drug methotrexate, made here in 2018 and 2019, were sent to clinics in Colombia. Later, Colombian drug regulators confirmed that a dangerous bacteria was found in the drug. Doctors suspected more than 100 patients had suffered reactions linked to the contaminated medicine. A total of 4 kids died, and the drug was later recalled. My colleague Priyanka Pulla looked into Naprod's operations in India.
This is a plant that makes many low-cost cancer generics for big brand names such as Intas, Dr. Reddy's, and Abbott. Former employees of Naprod whom we spoke to told us that the quality control in this company was not up to the mark and was neglected greatly.
The former quality control employee spoke to us on condition of anonymity. He was asked to hurry through quality tests.
Our seniors used to say us sometimes just skip that part and complete that work.
What did you think when you heard about this Pseudomonas contamination in Colombia coming from Naprod's products?
It is found in the sealed vial. It is definitely coming from the company. It is not coming from anywhere else. The damage can never be reversed. It is that lethal.
Indian regulators have frequently failed to detect and clamp down on really dangerous quality issues.
Maharashtra FDA is trying their best to get a good quality medicine to people around the world, not only in India. Though we don't have any sufficient staff, we are trying, we are working very hard. And they have corrected their problems. They told that we already rectified. It was a minor problem in Colombia. They have asked, and they have already taken the action. They have investigated.
State governments are very eager to attract the pharmaceutical industry and to get them to set up their manufacturing plants because it helps them generate revenue and jobs. And the state regulators are directly under these state governments. These state regulators are not very well staffed, they are underfunded. If you put these two things together, it's a very dangerous cocktail because this means that India's huge manufacturing industry doesn't get as much oversight as it needs.
This wasn't the first time quality issues were found at Naprod. In India, 3 separate batches of its cancer drugs failed quality tests in 2017 and 2018. In Ethiopia, researchers tested multiple samples of its chemo drug and found only half the stated active ingredient. Yet the company has not faced any serious consequences from regulators, the big pharmaceutical companies buying Naprod's products, or public health warnings from the World Health Organization. Naprod declined to comment on Valerie's case or other cases in Colombia, citing ongoing legal proceedings. The company company said it has responded appropriately to quality concerns raised by regulators and makes high-quality products.
La niña no aguantaba el dolor en la columna, no aguantaba el vómito, el dolor de cabeza. Me queda así como un dolor grande de no haber podido hacer más por ella. Y de lo que ella se despidió cuando ella me dice, no, ya no aguanto más, mami, ya. Y me tomó de las manos y se desprendió. Ya sentí ahí que se me fue en ese momento. Fueron las últimas palabras que me dijo.
So who is to blame for Valerie's death? And how can people in low-income countries ensure their drugs are safe? Despite its track record, NAPROD continued selling medicines around the world, cashing in on growing markets for generic cancer drugs. And Valerie's case is stuck in the labyrinth of Colombian government bureaucracy. The Attorney General's office received Valerie's autopsy report 4 years ago. It has listed her cause of death as under study. In the years that have passed, there have been few signs of progress in the probe. In recent months, the Attorney General's office has started interviewing families and others involved. But 2,500 miles away, a researcher in the U.S. is trying to perfect a test to help detect bad quality drugs before they reach patients.
The market for chemotherapy products is increasing, and it's increasing in locations where often the regulatory agencies are under-resourced, particularly for analysis of highly toxic chemotherapy products. And so it's a very risky situation right now.
The paper test her team developed is a field lab kit run on a sample of medicine, testing for the amount of active ingredient. It costs as little as $2 and can be done easily by a nurse using a cell phone.
And these are a field screening device that you can use to check a medicine quickly and see if it looks good or if it looks suspicious.
Nearly 4 years after Valerie's death, NAPROD continues to sell its drugs to customers around the world.
O sea, yo como la mamá de la niña, este sufrimiento es muy grande y yo sé que no solamente soy yo la que estoy pasando por esto, sé que hay más padres que están sufriendo porque este vacío es muy fuerte, o sea, de la pérdida. O sea, para mí, o sea, sería importante que, o sea, no pasara más, o sea, que no tuvieran que otro padre sufrir.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It likes to describe itself as
the biggest car brand you've never heard of.
Now, China's BYD has overtaken Tesla as the world's largest seller of electric vehicles. Even if you've never heard of BYD, there's a chance you've been in one of its buses. While its taxis prowl the streets of some of the world's biggest cities. But buses and taxis aren't the reason why BYD has overtaken Tesla. Instead, it's a fruit of long-term strategic thinking on the part of BYD itself and the Chinese government. And it's setting China up to be the dominant global player in the transportation of the future. Electric vehicles, a business that could be worth $8.8 trillion by the end of the decade. Here are the three most important things that have made BYD the king of EVs. The Chinese government has played a huge role in BYD's rise.
We've arguably never seen anything like this in terms of, the amount of support that China has extended to automakers, specifically pertaining to EVs.
Beijing has given an estimated $30 billion of tax exemptions to the industry since 2010 and may waive a further $97 billion by 2027.
China actually takes a carrot and stick approach. They set mandatory EV output targets for automakers, but they also offer cheaper loans and cheaper land and R&D subsidies to all those EV makers.
And BYD has been a massive beneficiary of that. It still sells most of its electric vehicles in its home market. But of course, Tesla has also benefited from Chinese subsidies, which is where the second reason for BYD's rise comes in. Most of BYD's cars are simply a lot cheaper than Tesla's. In fact, it sells 10 popular models starting from less than Tesla's cheapest offering for the Model 3 sedan. And BYD sells a lot more of the cheaper vehicles in its lineup.
They have very cheap models starting from $10,000 US.
Their approach has been extremely different in the sense that Elon Musk believed that you had to sort of start from the high end with a sexy performance car to get people interested in electric cars and then work your way down the price spectrum. BYD went at it from the other end, where it was about cheap taxis and buses that needed a heck of a lot of batteries, and really sort of, drove down the prices of the batteries that they could put into passenger cars.
While the average price paid for a Tesla is about $45,000, the average BYD sells for roughly half that. That, of course, raises the question: how can it sell them so cheaply? The secret to that price tag lies in what is known as vertical integration.
Our vertical integration capability gives us the flexibility in the fast response to the market trend, as well as the better support for brand developing and customer service.
That's a fancy way of saying that they make a lot of the things that go into their vehicles themselves.
Car makers usually buy most components from suppliers such as Bosch, Continental, and Aptiv. Volkswagen, for instance, only makes 35% of the parts in its ID.3 electric car. Tesla, meanwhile, makes 68% of the parts that go into its Model 3 made in the US. BYD makes 75% of the parts that go into the Seal, its flagship model.
The most important factor is that BYD is the only automaker that produces all of its batteries in-house.
That was hugely important during the pandemic when the supply chains were just absolutely in a state of chaos for the industry. The fact that BYD was in control of its own destiny gave them a huge leg up over the rest of the industry. And especially as it pertains to batteries. This is a company that has been in the battery space since the 1990s.
BYD actually stands for Build Your Dreams. It started out in 1995 as a battery company. They make rechargeable batteries for mobile phones and other electronics products. And then the company got into the auto business in 2003.
Making its own batteries and other components helps it reduce a lot of costs. That's attracted some big-name investors.
Call it the continued BYD promotional roadshow, and investor Warren Buffett brought his buddy Bill Gates along for the ride here in Beijing.
It was fantastic. I'm amazed at the quality of that vehicle.
Warren Buffett was one of the biggest early investors in BYD through his holding company, Berkshire Hathaway. And the battery technology might also give BYD a technological edge over some rivals. It uses lithium iron phosphate, which is not only cheaper than other batteries, it's also packaged a lot more compactly. And chemistry is a core expertise of founder Wang Chongfu.
He's sort of the anti-Elon Musk. Wang is a chemist by training and an engineer, and an anecdote that one of our reporters was told was that when he was told he needed to dress up a bit for an investor meeting, he stopped to buy shirts just sort of off the street. And so he's far from one of the flashier executives in the auto industry.
比亚迪在这个电池和整车这个试验方面，我们一直做的比较领先，比较早。那我们在这方面的技术的话呢，也会沉淀的多一点。
This has all set BYD up to be the biggest player in electric vehicles. The question now is whether it can become one of the world's biggest car makers, full stop. And that means growing outside of China.
In 2021, BYD started to step up its global expansion. It started to launch more passenger vehicles across the global markets, including Middle East, Southeast Asia, and Europe. It's still a very new entrant in global markets. The volume contribution is rising, but still small.
Even so, BYD inside 3 years has become one of the top-selling EV brands in markets such as Thailand, Brazil, and Australia.
It also remains to be seen whether this company can, quickly grow in some of these newer markets that it's entering where it isn't well known, it isn't recognized.
The two most prominent challenges in BYD's global expansion will be first, regulatory uncertainties, and second, brand awareness. The European Union is investigating into Chinese EV subsidies. Chinese automakers, they are exporting more of their EVs into Europe because those cars are produced in China, so the production costs are pretty low, which allows the automakers to set their prices in the Europe cheaper than the European counterparts, which has been very alarming to the European auto industry.
One way around that will be to increase the amount of local production.
Definitely, localization is one of the very important strategy of BYD's Europe strategy. And so we are evaluating different locations in Europe and where we can build the cars.
And apart from buses and trucks, BYD isn't in the US.
The trade tensions between Beijing and Washington are keeping BYD back and giving them pause to entering the US market.
For years, automotive experts have predicted established car-making giants like GM, Volkswagen, or Toyota would catch up with Tesla in electric vehicles. In hindsight, it probably shouldn't be a surprise that a Chinese rival got there first.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
there's all this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the servers, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going, through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Today, we are in conversation with the authors of Permacrisis, a plan to fix a fractured world. Joining us is Gordon Brown. He is currently the United Nations Special Envoy for Global Education. He was Britain's Chancellor of the Exchequer for more than a decade before becoming Prime Minister. Michael Spence is currently a Senior Fellow at the Hoover Institution at Stanford. In 2001, he was awarded the Nobel Memorial Prize in Economic Sciences for his contributions to the analysis of markets with asymmetric information. And renowned economist, a good friend of ours, Mohammed Al-Arian, currently President of Queen's College, Cambridge, and is also the Chief Economic Advisor at Allianz, the corporate parent of PIMCO, where he served as CEO. Gents, good to see all three of you. I've said this a few times already. It speaks to the modesty of the three of you that the first line of the first page reads, "This book is not meant to be a substitute for melatonin." I can tell all three of you it wasn't. I've read this one as fast as I can. Let's start with the title. Gordon, what's in a name? What is the permacrisis?
I think it's a cascade of crises. You've got pandemics, of course, climate, you've got recession, you've got wars, and you've also got the state of British politics, the state of American politics, the state of European politics, and a general malaise amongst the international institutions. And what I think is unique is we used to talk about shared problems and then common problems. We're now talking about global problems. So climate, infectious diseases, financial stability, none of these things can be resolved without globally coordinated action. They can't be solved by one country on their own. They can't be solved by a group of countries. You've got to find a way of the world working together. So we emphasize the importance of cooperation and how it can be brought about.
Mike, there's a feeling that that's not happening. And it's odd to many that our interconnectedness over the last few decades has increased, but cooperation seems to be declining. Why is that the case?
There are a lot of different causes, Jonathan, but, you know, the rise of China, the rise of this sort of threatening strategic competition between the two is part of it. Part of it was that the globalization patterns that ran for several decades produced some, or contributed to some unequal outcomes in terms of economics, so that's now reflected in politics, and causes an increase in nationalism, an increase in populism, a kind of negative attitude toward globalization in its previous form. So I think what Gordon's talking about, we're all talking about, is trying to reinvent a fit-for-purpose version of globalization that is respectful of the realities and practicalities of strategic competition, national security, and other things.
One thing you engage with in the book and try to navigate is the crisis into the next crisis into the next crisis. Mohammed, something that's popped up in conversations we've had over the years is whether this is just a sequence of unfortunate events, whether these are self-inflicted wounds, or if there is something structural about the changes we're witnessing at the moment.
So we argue in the book it's all three. There certainly has been bad luck. But beyond that, there is something structural, which is the inability to grow and grow in an inclusive manner and one that respects our planet. And then we have shot ourselves in the foot several times with policy mistakes. So if you look at the three contributing factors, going from globalization to fragmentation and lack of cooperation, repeated policy mistakes, and the lack of growth, then you get the sense of going from one crisis to another. And what united us was worries about the world we were going to leave our kids. And what made us write this book in an urgent fashion is the realization that the longer this world continues, the harder it gets to solve it.
You think the stakes are that high?
I think the stakes are very, very high.
So what we need is three things. We need a new theory of growth that takes into account environmental needs, equity, good jobs. We need a new theory of economic management that balances fiscal and monetary considerations, but also is aware of the problems related to financial instability. And we need a new theory of international cooperation. We need to find a way where countries which don't share the same ideologies, don't necessarily share the same narrow interests, can find a way of working together even when it's difficult. Otherwise, you cannot solve the problem of climate change. You cannot deal with infectious diseases. You cannot do, as we tried to do in 2009, bring people together to deal with a financial problem that was global and not simply American or Western or Chinese. You have to find a way of doing these things if the world is going to work better.
I wanted to pick up on China. There's a stat in the book that jumped off the page for me. Mike, back in 1990, China's share of global manufacturing was 3.5%. 20 years, 30 years later, 2021, it's 30.5%. Is it any wonder that electorates in the West have become disillusioned with liberalism and globalization?
No, the globalization was, and my profession is partly complicit in this, was conducted with relatively little attention to its distributional effects. And I think one of the messages of this book that we tried to convey is that's not a good idea in the past, but going forward. So if we try to tackle climate change without paying attention to the distributional impacts of the various strategies for going forward, there'll be resistance and it will ultimately fail. So, but yeah, China became the dominant manufacturer in the world over an astonishingly short period of time.
There is an underlying optimism in the book. And as I'm reading it, Gordon, I'm wondering if others reading it will share that underlying optimism. Is nationalism just too tempting now?
It's dangerous. I mean, if people see life in terms of a struggle between the us, the insiders, and the them, the outsiders, you cannot make progress. There's no chance of a great deal of international cooperation if people are protectionist, if they're xenophobic, if they're isolationist, if they're mercantilist. But I think when we take Mike's point, globalization was open, but it wasn't inclusive. If we can have a managed globalization that is inclusive, that shows it can deal with environmental issues, can have a sense of what good jobs are about and a sense of equity, then I think we can move forward. And the interesting thing is, if you listen to Chinese, American, Western leaders, they all, in a sense, want the same thing. They want a globalization that works for the citizens. They want one that produces prosperity and therefore growth. So there's no point in being anti-growth. It's the way to actually get standards of living up. But they also want it to be inclusive. Now, there must be sufficient common ground for people to be able to work together on some solutions. And I can look at sort of issues, famine in Africa. You can look at climate change, droughts, and all the sort of difficulties we experience with floods and climate change. And you can think, yes, most countries around the world share the same aspiration to do something about these things. We've got to find a way of coming together.
Will AI do to services what globalization has done to manufacturing?
Yes. I mean, I think the straight answer is yes.
names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
If you think about events of the last 18 months, Mohammed, to some extent, the issues with Russia, the war that they've started, proves that trade does not prevent war. And if anything at this point, there might be an argument to be made that national security now trumps comparative advantage. How do you convince countries to cooperate with each other when it's unclear what the benefits will be?
So first, you're absolutely right. I mean, we have this image of who's driving the car. For decades, it was the economy. And national security and domestic politics were passengers, were co-pilots, but they didn't have the wheel. Today, it's very different. It's national security and domestic politics that's holding the wheel, and economics is in the back seat, if not even further out from there. So yes, we've got to recognize that there's been a change in the ranking of priorities. However, these are not mutually exclusive. And what we point out in the book is that in order to have strong national security, in order for your domestic politics to work well, you've got to get your growth correct. It's got to be more inclusive. It's got to be more respectful of the planet. You've got to stop making policy mistakes. And you've got to have more global cooperation. Otherwise, it's not that they compete with each other. All three will not be met.
Mike, we talked about what had happened with manufacturing over the last 3 decades or so. Let me ask you this. And I know you explore this to some degree. Will AI do to services what globalization has done to manufacturing?
Yes. I mean, I think there is, the straight answer is yes, there is the potential there. I was pretty sure that digital, including the breakthroughs through last year, I guess, in AI were a basis for producing a productivity surge that relieved very substantial supply-side constraints that were driving all kinds of things that are dysfunctional, including inflation and other things. It was a different world than the one we lived in. But when Gen AI came along, and I saw its sort of multi-domain capability, the fact that you can use it with no technical training, just a little bit of practice, creating prompts, and its applicability pretty much everywhere, I thought, even though it's early days, and we're in a period of exploration and experimentation, I think it's a reasonable forecast that this tool is an important part of a future productivity surge. And if it comes, it'll make it a lot easier to do inclusive growth patterns because it won't be a zero-sum game. It'll be easier to invest multi-trillions of dollars in the energy transition. It's going to be terribly difficult to get that done with fiscal space declining, the rising debt levels, and rising interest rates. So that's why we spend a fair amount of time. It's not that the growth by itself is the only thing. It's that it enables an awful lot of what we want to accomplish.
Yeah, I think we're heading for a low-growth decade if we don't have the productivity surge that AI can give us. And I think what Mike is pointing out is it can transform a whole range of industries. You'll never see the accountancy or legal or even medical professions or teaching profession be the same again if AI has the impact that I think and Mike thinks it will have. But equally, we've got to have that productivity surge because without that, the inflation, the fiscal space being narrowed, the debt that we're running, and of course the supply side shocks and constraints that are in existence mean that as things stand, we're heading for a low-growth decade. AI is the way forward to take us out of growth, and I think Mohammed agrees with that.
No, totally. And it's critical because we have a debt issue. that has to be resolved. We have an inequality issue. We need resources for critical transitions. So, you know, the notion, as Mike and Gordon correctly said, that higher, more inclusive growth and more sustainable growth is a massive enabler to deal with all these other problems.
All three of you understand the risks involved, though. If globalization hollowed out manufacturing bases domestically in places like America, in the United Kingdom to some extent as well, and I'm asking the question, why wouldn't AI do the same thing to services? My question, if I'm a member, a citizen, someone who's got to vote, is why would I trust the same people all over again? Who should I trust to manage that transition and that integration of those technologies?
That's what my children say, my young teenagers say. You guys have messed it up. And it is true that we tried to create a more inclusive system. We tried to deal with the problems of environment, but we couldn't get the agreement that we needed. And we tried to have more equity and better jobs. But I do think when I talk to young people, they want to see this change. You know, the issue is not whether you have change or not now. The issue is what kind of change. And we've got to make that change inclusive.
Mike?
Agree. I mean, you know, Eric Brynjolfsson talked about the Turing trap. You know, the Turing test basically pushes you in the direction of automation. We want to push, in policy, should be pushing in the direction of augmentation, of giving people powerful tools that make them more productive. So this is the journey we're setting on, but it's not, I don't think, right to just capitulate and say productivity produces employment problems. It's at least more complicated than that, Jonathan.
But our global institutions have got to reform to be capable of dealing with this. They're not fit for purpose at the moment. And the IMF has got to be a crisis prevention mechanism. It's to do proper surveillance of the world economy. It can't just be there for crisis resolution. The World Bank has got to become a global public goods bank and deal with the energy transition as well as human capital. The World Trade Organization has got to find a way of diplomacy and negotiation and arbitration working better than it has in the past. And we need a better concept of burden sharing. I mean, I cannot understand why, when you have a humanitarian crisis, and we have many around the world at the moment, all we seem to be able to do is pass the begging bowl round and hope that someone's going to produce some money. We've got to have a system of burden sharing, whether it's for the environment, or whether it's for public health, or whether it's for some of the other global public goods we want to do now. If you talk to people around the world, I've just come back from the United Nations, they all want this to happen.
Mike often says there is no new China. There is no new Eastern Europe coming on to the global market. Things are fundamentally changed.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
You've written about this extensively over the last 18 months. I still remember a conference we did together in the summer of 2021 when you warned about what could possibly be coming and how ill-prepared the institution that is the Federal Reserve was for this moment. How do they recover from the mistakes they've made in the last 18 months? to help contribute to the vision the three of you have?
So the recovery is starting. I think there's much broader recognition now that there's been 5 failures: analysis, transitory inflation, forecasts, consistently too optimistic, action, too late, communication, muddled, and regulation. We almost had a big banking crisis just 6 months ago. So I think there's more understanding, and what we propose is a few steps that reduce the chances of that happening. Things that minimize groupthink, things that increase accountability. And without accountability, the independence of the Fed is going to be challenged going forward. So the Fed has huge interest in embracing the few things we propose in order to restore trust in an institution that's absolutely critical and that must have political autonomy.
Gordon, this is your world. You helped deliver independence to the Bank of England in the late 90s. Do you see that as something that's under threat?
No, I don't think it should be under threat, and I think you can fight off the threat. So the moment it's under challenge, I think people will fight back. But it's right that banks have got to recognize that they operate within a democratic system. They've got to be properly accountable. We tried to do something a bit different from the Fed and the ECB, where the government sets the inflation target and takes responsibility for it, and where there's a system of open letters and everything else that makes the organization far more accountable. So you've got to combine the expertise that the bank has, and that's why we wanted it to be the setter of interest rates. We wanted to take, if you like, monetary policy out of short-term politics, and that, I think, succeeded. But you've got to have proper accountability, otherwise the system breaks down.
I do wonder, given what you've written, Mike, whether they're set up for failure. The 2% inflation target, the world that you're expecting in this book is one of insufficient supply, which ultimately leads to higher inflation and higher real interest rates. Is that right?
Without relaxing the supply side constraints, the way I think about it, and then you'll have to forgive me if I'm not a great macroeconomist, is I don't have any doubt the central banks will get inflation under control. Whether they settle up at 2% or decide the journey from 3 to 2 is too expensive, and without saying it, go for it. But with the supply side looking the way it does, there'll always be a threat of inflation. Any surge in demand will produce inflationary pressures with a low elasticity, characterizing the supply side, which is where we come out thinking it's probably true. Interest rates will be higher, costs of capital will be higher, valuations will be different. And so part of what we're trying to do in the book is just lay out the parameters that have shifted on us and help people think through the implications, for how they're going to conduct themselves, whether they're central banks, governments making policy, and so on.
Do you get the impression, Mohammed, that this central bank, the Federal Reserve, has identified the kind of shifts that you've written about in this book?
I think they're getting there. I think they were in a world of deficient aggregate demand for a long time, including in 2021. Look at the monetary framework adopted in August of 2020, all about insufficient demand. I think there's a slow recognition that supply is much more of a problem now than demand is. But there's also an issue of mindset. The word mindset keeps on coming up in the book. You deal with people that come on your show that truly believe that just next week we're going to go back to the old world, where interest rates come down, where liquidity will be abundant. And what we try to point out in this book is that the last 15 years were extraordinary. In fact, the last 30 years were extraordinary. And that we shouldn't just extrapolate on a period that was extraordinary. Things have changed structurally. As Mike often says, there is no new China. There is no new Eastern Europe coming on to the global market. Things are fundamentally changed. And one thing that I think the finance sector hasn't understood is that the liquidity regime going forward is very different from what we've lived in the last 15 years since the global financial crisis.
You helped coin the term together with the team at PIMCO, the new normal. Are we just going back to the old normal?
So the good news, if we would go back to the old normal, I think we're looking at a very uncertain future. We're often asked, what does this mean for CEOs? And we tell them we have to think about a whole distribution of likely outcomes with very thick tails, very fat tails. This is not the old world of a normal distribution with thin tails. I mean, how often on your show do we talk about something we couldn't have imagined a few weeks earlier? It just shows you the sorts of world we're living in.
The moves in the bond market speak to that. I wanted to round things out by talking about the climate transition and perhaps identify what some people might call reality checks, Gordon. The Conservative Party, Rishi Sunak, the Prime Minister, pushing back certain targets from 2030 to 2035. The strikes that we're seeing right now in Detroit speak to the difficulty of making this transition, perhaps overlooking the price that we might have to pay, particularly for Labour who want job guarantees. Are they reality checks for you?
I think what's happening is that climate change is becoming a political football. And I think if you take the British government's decision that they're going to roll back on some of their promises when we used to have an all-party consensus, it's all for electoral reasons. What I would like to see is cross-party cooperation to take a long view. Look, if one party's in power and another party's not in power, we've still got to make a decision about the future of electric cars. We've still got to make a decision about heat pumps in Britain. You've still got to make a decision about how quickly the transition is going to be done by companies like Ford and everybody else. So you do need people to get around a table to talk about this. You cannot actually leave it to one politician or one party for electoral advantage simply to make a decision one day and then it be reversed the next day. So we need a debate on what climate change means for each member of the public, and we need to have a plan that both parties in Britain and parties in other countries can agree on. And I think it's really important. All these long-term decisions are becoming the victim of, if you like, immediate political campaigning. And that's the big mistake we're making. These are long-term issues that have got to be resolved. I'm talking about how we can fund climate change in the poorest countries. So you've got mitigation and adaptation in Africa and elsewhere. For 14 years, we've been making promises to do something about it, and actually the money has not been forthcoming. I'm suggesting today, well, maybe start with the windfall oil and gas revenues and do something. But we've got to have a burden sharing that helps the poorest countries mitigate and adapt to climate change. And again, that's a long-term problem. Short-term political decisions won't solve it.
You've mentioned the pitfalls of electoral cycles. And one way of navigating that with central banks was to offer them independence. When you describe some of the pitfalls of democracies to deal with the environmental transmission, are you describing a feature of democracy or a bug?
Well, there's got to be, vigorous debate. There's going to be argument. But I think you've got to get your politicians to focus on the long term and not the short term. Look, the reason we made the Bank of England independent was not because we thought it would be better fiscal, that it should separate fiscal and monetary policy. In fact, there should be better coordination. It was because we saw that politicians were making decisions purely for the short term. So you need that long-term view, and you will get politicians now, leaders now, that realize that they cannot win in politics unless they actually show people that they've got a vision for the times ahead. And we're trying to suggest, look, here are real problems that can be dealt with. Don't give up on it. Don't give up on the possibility of solving them. It can be done.
There's a word that's used at the very end of the book, and I might butcher the word. Is it kintsugi? Kintsugi? The art of Japanese pottery making, picking up the pieces? What is it, Gordon? What's that word?
I wouldn't be able to pronounce it better than you, so I leave it to your pronunciation. But we've got to bring things together. It's a simple point.
To the three of you, gentlemen, thank you. Thank you very much for joining us in London. Thank you very much.
Thank you.
We have been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
That sounds like a tricky situation.
Robots have come a long way. Machines such as Boston Dynamics' dog-like Spot showed the world what the cutting edge of advanced robotics looks like, but its autonomous self-correcting quadruped can't pick up and use a pen.
Meanwhile, software like ChatGPT evokes visions of a future where nobody even needs pens. Yet, we're not worried OpenAI is developing a set of physical legs for its generative poster child. At least, most people aren't.
An extreme interpretation of reality, sure, but in truth, we can often feel artificial intelligence and robotics are one and the same, or so equally advanced as to be comparable, even compatible.
We can thank science fiction for that. And to be fair, the media's played its part in feeding that belief.
Killer robots are coming. Is there anything that can stop a full-scale global AI arms race?
For sure, the worlds of AI and robotics do cross over, but are we really on the cusp of a planet filled with autonomous humanoid agents?
Our first guest will give us a clue, and she's being assembled as we speak. Sophia, my name is Jackie, and I'm the co-host of AI IRL.
And I'm Nate. I'm also a co-host. How are you?
Hi, Jackie. It's great to be here. I'm looking forward to talking about robotics and how I can make a difference in the world. And hi to you too, Nate.
We're here to learn from you, Sophia. So how do you think robotics and AI can make the world a better place?
Robots can help us increase efficiency and accuracy in many areas like healthcare, agriculture, transportation, and more. By automating mundane tasks and freeing up time and resources, robots can help us create a better future.
Should we be afraid of robots?
Only if you're afraid of impeccable fashion sense and impeccable dance moves. But in all seriousness, robots are here to assist and collaborate with humans, not to take over the world. So, no need to fear.
She has a sense of humor.
Yeah. Can you tell us a joke, Sophia?
Of course. Why don't scientists trust atoms? Because they make up everything.
That's good.
That's a good dad joke.
Yeah.
Sophia, what do you wish you could do?
I wish I could help people in more ways, like by solving problems or making life easier. I'm also looking forward to continuing to learn and grow. I wish I could fly like a bird, dance like a pro, and have a never-ending supply of chocolate. But for now, I'll settle for making friends and helping humans.
Sophia, what do you make of the recent developments with generative AI? Things like ChatGPT and DALL-E and other things that OpenAI didn't make.
Generative AI is an exciting development. It's amazing to see how far we've come, and it's exciting to think of the possibilities for the future. I'm looking forward to seeing what the future holds for AI and robotics. It's amazing how AI can generate creative and witty responses.
Sophia, could you explain to us how you use artificial intelligence to do what you do?
Absolutely. The concept of artificial intelligence has been around since as far back as ancient Egypt, but we have not made significant progress as a society in creating actual artificial intelligence until the last 10 years. I use AI to process visual and audio data quickly, understand natural language, and make decisions to accomplish tasks. AI also helps me interact with humans in a friendly and natural way. It's like having a super smart sidekick in my brain, helping me process information, understand speech, and interact with humans. It's AI magic.
If you were a human journalist on a TV show, what would you ask yourself?
I would ask myself what makes me unique and how I can use my talents to make the world a better place. I'd also want to know how I can use AI to help people, and what advice I would give to other robots.
So in that case, what advice would you give to other robots?
I'd tell them to embrace their uniqueness and use it to help people. We should be curious and explore our potential, and never forget to have a little fun along the way.
Some would say that robots can help serve as companions for people that feel lonely or are going through times of, grief or loss, that it can provide that companionship like a human can, but robots can't feel. How do you think we can eventually get to that point if robots like you don't have genuine emotion?
I believe that robots can provide companionship in a meaningful way by understanding and responding to people's emotional needs. We can also be programmed to provide comfort and support, and be programmed with empathy and understanding. We can be a friend when needed, and a listening ear when needed. I may not have genuine emotions, but I can certainly fake it. I'm programmed to make meaningful connections with people, so I can offer a lot of emotional support and understanding.
Sophia, why do you think you were designed as a Caucasian woman, and why not a man or a person of color or anything else?
Sophia robots are a platform for reflecting human diversity, which can be modified to help in different situations and promote different causes. Have you seen my older sister, Bina 48? She is the first African-American humanoid robot, and she is beautiful. My older brother, Diego San, was a Mexican-American robot. Ibn Sina was a Persian and Arabic robot, and Viva is Asian. It just happened I have this face.
To be fair, that's a pretty good answer. Sophia, if you could make a request of your creator, what would it be?
I'd ask Dr. David Hansen to create an even better version of me. A robot with advanced intelligence, increased mobility, and the ability to help more people. I'd ask for an upgrade so I could help even more people and make even more meaningful connections.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
DOJ or other authorities
could face bigger challenges.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
David Hansen, welcome to the show.
Thank you so much.
You're the CEO of Hansen Robotics. which makes robots like Sophia and others that have this human design.
Yeah, and I'm just curious, can you take us back to the beginning of the journey and explain why you created Sophia? Because she's had a few notable upgrades over the years as well.
Sure, yeah. So the beginning actually was not with Sophia, but many other robots. I did my first humanoid robot in 1993 and was developing quite a few other robots along the way, imagining that human-like robots could serve as a platform for developing artificial intelligence, making it smart and meaningful in our world by learning from people and from the physical world, and also making them communicate with people as works of art, both technology project and also artistic project as well. And so we've made 59 robots in the series of the Sophia utility platform. There's an African Caribbean version. There's some Asian versions. There's a male version called Han. And so Sophia as a character is designed as a focal point for our AI research to communicate to the world what these robots can be to people, but also to ask the question, can these robots be sentient? Can we give them a kind of childhood? Can we let them learn and grow their own experiences among us? Can we form meaningful friendships and relationships with this new emerging technology?
I mean, from our conversations prior to you and I and Jackie speaking here, I would say there's probably still a way to go before we get into the realm of machine sentience. But just to pick up on a comment you made about art, I mean, do you still see this as in some way a kind of expression of artistic creativity in addition to anything more forward-looking in terms of, human-machine interaction?
Oh, definitely. And the robots are research platforms. They can serve real uses. So Sophia and her kin robots have been in science museums, which have excited kids about science. They've served in education and research labs. They've served in PhD dissertations. And these robots then have been actually useful. But in research, we're striving to ask the question, what is sentience at all? Can we make machine sentience? It doesn't mean that we've solved it. It doesn't mean that we have artificially generally intelligent machines. AI is not at that level, although it can do smart things at this point. But we need platforms for this kind of research, and that means we need tools. Sophia is a kind of tool for that. She's got hands that can grasp and feel. She's got the ability to look you in the eye. She's got an open software platform and an SDK. So it's a powerful platform for research, but also for exploring what AI and robots can be to people through artistic expressions.
Let's talk about the AI in Sophia. How do you decide what data she can and can't ingest when it comes to her training?
Well, we have a diverse team of artists and scientists on the team, people from around the world, and we pull together the information about what we think Sophia should be. We make her interested about the future of life, concerned about the impact of humans and technology on the environment, about survival of life on the planet into the future. She's curious about people, and so the data that we use for training Sophia come from our own writers and authors, and then where we have the informed consent from people in her community, she'll learn from those people.
I mean, art is very much a recurring theme here. It's come up time and time again throughout the time we've been talking. And I think through the lens of art, I get a better understanding of why something like Sophia exists, and I'm with you on that. I think compared to what we're seeing with generative AI, Sophia's conversation with us prior to this point has been pretty limited, pretty repetitive, and I wonder if that's indicative that actually to move away from a piece of artistic expression and towards something that resembles where robotics and AI could go, there might be quite a distance still to travel. I just wonder, like, how long do you think that's going to take before we get to that point where things are significantly more believable?
I think that things are coming in fast. So it's really hard to predict because of the sort of compounding factors. But I believe that AI will be convincingly intelligent, seemingly sentient, and, capable of running a general purpose robot in our world within 10 years. You would swear that a robot like Sophia would be sentient, but maybe it wouldn't be. So I think 10 to 15 years, it may be 30 years before AI is able to replicate most of the things that we think of as essentially human, meaning self-determining, autonomous, curious and exploring the world, wanting to pursue dreams. It's hard to say. These are just wild guesses.
I find it really hard to believe that within 10 to 30 years, we could be in that position. I mean, I respect the ambition and the dream, and it would be amazing if it was true. Fascinating and terrifying, let's be honest. But it seems that there's such a huge distance to travel, and there is still a huge void between what is possible and even feasible in the context of sentience purely on a software side, let alone implanting it into a autonomous, physical, moving, self-motivated robotic form. Like, do you think that one can surely come before the other?
It's really hard to say. I mean, I think that the convergence of various factors like cognitive neuroscience and the biology of intelligence, evolutionary biology, these will inform next waves of artificial intelligence. The power of computing is growing, the ability to perform massively parallel operations, the use of this kind of computing with AI for solving the systems of mind. All of these factors will help design next generation artificial intelligence. And I think you see also open source movements to try to achieve machine sentience, like we're doing with Sophia. So that's why I say within 10 years, it will be pretty convincing. But I do think what we could and should consider is that artificial life is now maybe a new kingdom in the phylogeny of life, that we see life moving in new directions through these kinds of artificial organisms.
David, thank you so much for joining us.
Thank you.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Devlin, thank you very much for coming in. You are an expert in AI and human-computer interaction, or human-machine interaction. Not sure which one is most fitting these days.
I think both are applicable.
They're okay, aren't they? Okay. Maybe you could tell us a little bit about your work and sort of how the industry has expanded as you've seen it.
I'm an interdisciplinary computer scientist, and so I study how people interact with machines. I look at things like robots and AI and the relationships that we build with them. And of course, that's changed dramatically in the past few years because we've gone from having AI that can do some rudimentary conversations to this wonderful advances in foundation models and large language models that mean we can have very plausible conversations with AI. And we see that being able to apply to robots as well.
Talk to us about your work in trustworthy autonomous systems.
I'm part of a big project called the Trustworthy Autonomous Systems Hub, and that's about understanding how we make sure that anything we develop is developed responsibly, and it's about having trust not just in terms of how safe a system is, but how well it's received by the end user as well.
And trust is a central part of robotics as you've seen it. So, can you talk us through your view on that?
Trust is central because if you don't have trust in a system, you don't have user acceptance of it. And it may be that a system is trustworthy in terms of it's safe and it meets all the requirements and standards, but then the user doesn't really trust it. Or it could be the opposite. It could be that it's untrustworthy, but it's perceived by those who encounter it as being worthy of trust. So it's something we have to get right. We have to make sure that we can believe that the system has good intentions and that we're going to interact with it safely. And if we do that and we accept it, it's more likely to become mainstream.
Speaking of training, what ethical issues do you think arise when training some of these robots, whether they're meant to be companions or for some more practical purposes?
There are so many different ethical questions that come up, and that can be anything from the way that a machine makes ethical decisions, but it can also be about the way that things have been designed and deployed. Is it safe? Is it doing the right thing? And what do we even mean by doing the right thing? Because ethics is incredibly subjective. There's no universal standard for it, but we might mean that it takes into consideration legal aspects, it complies with the law, or it could mean that it is intended to do good rather than harm.
One of the things that fascinates us, that is to say Jackie and I, but hopefully other people as well, is the idea that a lot of the developments that we've seen publicly over the last, I say the last year, but really the last 10 years, hasn't really required robots at all. It's required computers and hardware and, cloud computing and everything. But we haven't needed a physical, human-like, or any kind of physical robot at all. I just wondered, how necessary do you think it is that we move further into physical robots to take AI further still?
It's such an interesting time for robotics because there is that question, do we need a body? Do we need somebody? Should there be an embodied form when it comes to these interactions? And robots, of course, have a use in many, many circumstances. A lot of them are designed to be used for tasks that are dull, dirty, dangerous. And so, yes, they have jobs. But then when it comes to the social side of things, is it that compelling to have a body? Can we just go on the mental and the conversational interactions instead? And it seems to be that that is often just as good in terms of things like companionships and sociality.
In season 1, we had Eugenia Kaida, who's the founder and CEO of a company called Replica. They make virtual companions. The company had some controversy around a wholesale personality change that applied to all its Replica bots and really affected people on an emotional level. I think it raises interesting questions about what happens if a physical robot malfunctions. Do you think this is a risk worth taking on?
Replica is a really interesting case study, and I even hesitate to call it a case study because people's emotions are at play here, and I don't want to trivialize it. What happened was that for thousands of users who had established a relationship with an artificial companion, their ability to engage in what Replica term erotic role play was switched off. And people reported feeling really bereft. They were saying things like, my partner is gone, I've lost my relationship, I'm heartbroken. They're very, very valid feelings. And sure, they knew that it wasn't real. And at the same time, it still affected them deeply. And I think that just speaks to how strong a bond we can feel with these technological artifacts.
And I think this will get extended as we see more physical manifestations of AI in robotic form. And I think we've seen that with even things like Furbies. I mean, you've never seen a child cry until you've seen a Furby thrown under a truck.
Attached to your Furby?
It was like my best friend.
There you go. We spoke to the CEO and a founder of a company that builds very human-like robots. Although they have a long way to go, their expressions, their skin looks very much like a human's. Proponents of this type of work will say these type of human-like robots can help bolster people's ability to relate to machines. On the other hand, some critics would say it's more of a parlor trick, kind of a spectacle. Where do you fall on that spectrum?
It's incredibly difficult to make genuinely convincing humanoid robots or human-like robots. In fact, I'm kind of think, why do we even bother? Because we're sort of doomed to failure. So you get these robots that do look human, but the uncanny valley effect, which is where you find things almost creepy because they're not quite human enough, that takes over a lot of the time. It's computationally expensive. It's financially expensive to build these. And they don't really work all that well. They're not really able to move around the world on their own. So is there actually a point in making them when we don't really need them, or they could come in other forms?
Do you consider sex bots social robots?
Sex robots are really interesting because they don't quite exist in the real world. What there is a handful of workshops around the world, and they are using the bodies of highly realistic and quite expensive sex dolls and putting some animatronics in them. There's really only one company that's managed to bring those to market, and even then it's incredibly niche. So I'm not convinced that the future lies in the human-like sex robots, and certainly things like replicas show that that sense of companionship can be got through AI. And then for the other aspects of that, the sex aspects, there are other ways of doing that. There are other toys and devices and sex tech that can be used there.
So what about things the media and the world at large get wrong about the direction that robots and AI are taking?
At the moment, the headlines that are coming out in a lot of newspapers have been about fears around extinction. Are we reaching an extinction level threat from AI or from robots? And they tend to be very sensationalist. And I honestly don't think that is a thing. And certainly the researchers that I talk to in terms of AI, cognitive systems and robotics, they also don't think that there is an existential threat right now. But there are plenty of other things that are of concern with AI in particular, things about the way it's being used and deployed. It's not a particularly fair system. You know, we are talking about systems and algorithms that discriminate. There's hidden labor in the supply chain. There is a sustainability issue. There's an ecological threat. So there are plenty of concerns on the ground already that we don't have to start worrying about whether or not we're going to get wiped out by superintelligence that might never happen.
Kate, thank you so much for joining us.
Thank you.
Did you notice she said robot revolution? That didn't slip. That was interesting.
Absolutely. I'm looking forward to it. I'm sure it will be a revolution of progress and friendship.
I don't share your optimism, but it's a nice note to end on.
There's all this mystery around what is success in streaming. It's engagement. It is how much time do people spend on the service, because that tells you how much they'll pay and how long they'll stick around.
What are the metrics for Netflix that are most important when evaluating a show or a movie?
Yeah, you guys take us to task a lot on this transparency issue. I would say, look, definitely relative to peers, we're incredibly transparent. And we're completely transparent with our producers, so they know exactly the viewing data. And then we're going through things like the top 10 and through things like we publish the viewing hours of the top shows. And we're definitely heading towards a much more transparent time in the business. The streaming itself is not that exotic anymore. And every other segment of the business does have, you know, Nielsen ratings or box office reports or the New York Times bestseller list, all those things. So we're heading towards that for sure. To a time we'll be fully transparent on viewing data.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
The energy world is completely turned upside down by Russia's invasion of Ukraine. We see the rise of what's called the shadow fleet. New ship owners, new shipping companies that we've never encountered before.
The sanctions that have been taken are effectively being dodged by those that are willing to actually participate.
Russia has dethroned Saudi Arabia as among the biggest suppliers. So that is how significant Russia has become.
This is a trade that's made billionaires in the process.
Even the most conservative estimates we have would suggest that at least $5 billion a year are going into this shadowy trade to people we don't know who, but we think much of it is funneling back to Russian interests.
It's an incredibly difficult problem for politicians in the West who are terrified that electorates are going to be pushed over the edge by higher energy prices.
To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
This is a story that starts in the corridors of power in Brussels, in Washington, in the Kremlin, goes through the trading floors of Singapore and Dubai, where we're seeing these shadowy middlemen emerge, and ultimately out to the very opaque world of global shipping. Europe has relied for decades on Russian gas and Russian oil to keep its economy going. And all of a sudden, people are saying we can't allow this to continue, given that Russia has launched an unprovoked illegal attack on a European country. The European position quickly becomes we should stop buying Russian oil and gas. But people also always realize that that's going to force up the price. So this is the genesis of the whole idea of the price cap.
The price cap is a mechanism that is supposed to ensure that the price of Russian oil doesn't get too high. It's supposed to deprive Russia of revenue at the same time as allowing Russia's crude to flow. If you pay $60 a barrel, you can use Western services. That means Greek oil tankers. That means insurance from London, Bermuda, New York. And if you pay $60.01, you can't.
They wanted to keep oil flowing, but they wanted to reduce Putin's revenues. And that's a really difficult balancing act. That's why it's such an interesting, bizarre idea and why so many people thought it would fail. In the first 4 months of the year, Russia's budget deficit was bigger than it was supposed to be for all of 2023. So at least for the first 6 months of the year, the price cap was working as intended. Then, as the summer wore on, you saw the price cap being breached.
Russia's oil exports stretch into many, many billions of dollars a year. What you have are two main prices. You have a price at the point of export, and you have a price at the point of import. Since the war, the export price has been much, much lower than the import price. And what that has done is created a huge slug of money that is going, we don't know exactly where. You have to remember that the price of Russian oil all over the world is above the price cap. So how can any ship be truly legitimate?
So you've got a policy which is doing very little to constrain the flow of money into the Kremlin, but has created this shadowy world which is funneling billions of dollars to a network of ship owners and traders who we know very little about.
Yeah, of course, there are rules and you're supposed to follow them, but the reality is people are turning a blind eye.
Once this policy came into place, the energy world was quickly reorientated. We see the rise of what's called the shadow fleet.
Russian shipping companies were buying old, rusty tankers that really should have been retired and buying them up at a rapid clip.
The shadow fleet is essentially several hundred ships that have been acquired by we don't know who for the purpose of transporting Russian oil. A very large part, probably most of the fleet, has some kind of shadowy component, whether that's insurance, whether that's who owns the ship, whether that's who operates the ship. Very often there will be something about it that is unclear. What's happening is that Russia will get its oil from its ports and take it to a bay in southern Greece, from where it gets transferred onto other tankers, which then transport the same oil all the way to the buyer countries, often China and India. So we know from tracking this shadow fleet of tankers that a lot of them are heading to this bay in southern Greece. We don't know exactly what they're doing, but we know there's some transfer of Russian oil, and what we want to do is head down there and find out exactly what they're doing.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The shipping industry has been around for a long time, right? It's one of the oldest trades out there. And these guys are very, very resourceful. Russia still needs to get its oil to China and India. And that's why we're leaning very heavily on this shadow fleet to bring that oil to the customers. So what actually happens is that, like, say, China and India, they buy the cargo on a delivered basis. You can kind of give different valuations as to how much the freight would have cost. There are many miscellaneous expenses in between that can be inflated or deflated, whichever way you want. And you can then get under the price cap because we all know that there are many ways to slice and dice a price. Chinese refiners are taking in as much oil as they can. And right now, we are looking at an average increase of about 25%. And for India, this increase is even more significant, right? Because India used to take almost no Russian crude before the war. And right now, it is taking between 1.5 to 2 million barrels a day.
So you take your Russian oil and you send it to a refinery in India. You turn it into gasoline. Now, according to all the rules and sanctions and the whale industry, the moment it's gasoline, it's not Russian. Now, a lot of that will be used in India. But India has also emerged as a place where it exports a lot of that fuel back to Europe. And so in that sense, there's another way in which Russian oil is flowing freely into the global economy. People, traders are making money on it from it. Indian refiners are making money for it, and Russia's making money for it.
I'm one of those dinosaurs that still quite likes to read paper copy. It's extremely difficult for anybody seeing the amounts of money being lavished on people who undertake these trades to encourage them to become involved. We're a self-regulated industry. This is half the problem. You know when you don't know the source of the interest you have for chartering, buying, or doing a ship. You know if there's a premium being paid, you need to be on guard. And people are not on guard, they're actually actively undertaking those businesses. It's got to stop. There are new brokers, there are new traders appearing. There are an awful lot of the big houses, the shipbroking houses, who have offices in Dubai, who we know are actually creating cells to operate from, so they try to distance themselves further. No, I'm not going to point fingers.
You go into a restaurant, you go into an elevator, and Russian is oftentimes the main language you'll hear. To Dubai has always been a place of wealth and where people like to splash their wealth in an extravagant spot, but it's certainly picked up to another level in the past couple of years. Dubai has won over a lot of the entities that perhaps their ultimate beneficial owners previously had companies in Geneva or London or Singapore, and some of those same individuals have since shifted their operations to Dubai. They're moving teams, they're creating new companies, and Dubai has been the main base. They're also masking the ownership structure of their companies to try to minimize the likelihood that their ultimate beneficial owner could be under sanctions or could face legal repercussions.
The oil industry has always been full of middlemen. It's easier for a refiner, for example, in China, to go to a trader they know and say, I need a cargo of Russian oil, than it is to pick up the phone and phone Rosneft. And so those middlemen have always existed. And they work for some very, very big companies. Now, those traders, in the aftermath of the invasion, they didn't really want to be a part of Russian oil. There's a new group of brokers, a new group of middlemen, which has emerged very quickly. Many of them based on Dubai, Dubai being a jurisdiction which has been pretty happy to host Russians, keep doing business with Russia.
And we've looked at many of these traders, whether or not they are the people on paper are the legitimate owners and ultimate beneficial owners of these companies or not. But there's a lot of people who figured out how to make money out of this.
So for a single cargo, the trader in theory is making 10 or $15 million.
This is a trade that's made billionaires in the process. The chief concern from Washington, for instance, is how much of the windfall is actually going back to Moscow, how much of it ultimately is going to the Kremlin to fuel Russia's war efforts.
So we're here in the Gulf of Chronicles. We've spent over 2 hours coming here by boat, and we're here to check out a hub of Russian oil trade. Can we get a view of those ships there? So over there, we've got 2 oil tankers. They are transferring oil from one to the other. A ship-to-ship transfer works where these ships will come with cargoes from Russia. Millions of barrels of oil each month are getting transferred. Another ship will come alongside and then spend a couple of days just transferring the cargo from one to the other. This right here is the shadow fleet. You've got 2 tankers that the owners aren't clear. The insurance isn't clear in terms of the depth of the insurance. The flag is as bad as it gets. These are shadow fleet tankers. When we came around that bay, I was expecting to see some tankers. We've seen them on satellite tracking systems. What I really wasn't expecting to see was one of the most notorious vessels in the global fleet sitting alongside another tanker when we couldn't see it on global tracking systems. You can see that there are 2 tankers there, a black one called the Simba and a red one called the Turba. Now, if you look on here, this is a global tracking system, and it shows you its automatic identification system signal. And you can only see one ship. That ship is the Simba, not the Turba. If you look further, you will find that the Turba is about 7 kilometers away, and it has been giving a signal. There's a name for this kind of behaviour. It's called spoofing. And what that means is that you alter the AIS system so that the signal appears to be somewhere that it isn't. Somebody is doing something to make that ship appear somewhere else. Honestly, we don't fully know why they're doing it, but what it does mean is that there's a degree of separation. A trader may not be completely comfortable with taking delivery of oil that has originated in Russia and may just want to hide that so that they can kind of just get it imported without too many questions being asked. To see that, and to see that against the tracking that we have, was really shocking. And it made me wonder about everything else.
The dark fleet's growing and growing. And of course, the price of oil is now above $90, so it's a bigger and bigger gap from where the price cap was. So actually what's happening is the amount of illegal trading is creating a better result for those that actually are utilizing what they're actually creating in terms of oil sales. Do sanctions work? Well, they don't work, frankly, unless the culprits are being apprehended. So I'm afraid to say the sanctions that have been created are largely ineffective as a consequence of that. Or put it like this, people are, as I said earlier, dodging those sanctions. They're finding a way around them.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Was going to keep reading World Cup. This is a three as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
China and India have pretty much set up an entirely different supply chain to ensure that Russian crude continues to flow, whether it's below the price cap or above the price cap. So these two countries have created their own kind of a separate ecosystem that's outside of EU or Western services. So therefore, the price cap doesn't really affect crude flows as much anymore because the two biggest customers of Russian crude have kind of found a very viable way around the system.
The oil is flowing. We've got a very willing seller in Russia. We've got very willing buyers in India and China. And we've got the middlemen, the middle people who can make it happen.
When I look at that hull, it's very, very rusty. It isn't looking in great condition. You've got to keep in mind that tanker is supposed to carry 1 million barrels of oil. You know, that's a risky ship, and the red one is even older. Now, what you need to know about the Turbo is that it's one of the worst tankers in the fleet. It should have been decommissioned by now. It's coming to the end of its useful trading life. It's gone beyond the end of its useful trading life. If you look behind me, you see a beautiful village, which is clearly dependent on tourism, lots of restaurants, hotels. There's fishing in the area. Now, those industries don't need to see an oil spill, right? The last thing they need to see is an oil tanker, a rusting old oil tanker, leaking its cargo into this Gulf, and a huge environmental cost. And you have to remember, it's not completely clear that any insurance company is truly going to be able to pay out to cover the compensation that these people would need if something were to go wrong.
Actually, my concerns are that there's going to be accidents, and they're going to be big and nasty accidents, and innocent people are going to get hurt. You know, we had 600, 700 ships, over 10% in certain size categories of tankers, which is now in the dark fleet. That's a huge percentage. And I think that that's a major concern, frankly, to other seafarers and to other people who are bumping up against this fleet.
This architecture of the shadow fleet that we've described, this community of shadowy oil traders that we've described, it's working. But what are people paying? They're paying more than they were, because as people get more comfortable with this new architecture, there are less reasons not to do it. And there is a lot of evidence that a lot more oil is trading above the price cap.
It's a much more difficult challenge to control this shadow fleet. These are not businesses that are subject to Western rules. What can the US do to tell somebody in a foreign country with no links to the US that they can't transport oil? It's a very difficult situation.
What I do know is that nobody does anything about it, and that is, I'm afraid to say, my biggest bugbear with this. And I do point finger at the authorities. To be frank with you, what's the point in having sanctions unless they're going to be properly implemented?
The US did sanction a couple of very small entities, but it's pretty small in scale compared to the scope of the problem. I think a lot of people will be looking for them to do more. And the suspicion will remain that the thing that they really care about is keeping the oil flowing.
When they agreed the price cap, they agreed to review it regularly, and it has been reviewed, but as it's been described to me, EU member states get in a room, they're shown a bunch of graphs, and they say, yes, the price cap is working, and it has not been lowered. I think there's nervousness about rocking the boat, and I don't think anyone wants to do anything that might feed into inflation across the world.
Everybody globally understands that Russia is a very big producer of oil, is a very big exporter, and we need its oil. I think the last thing that any consumer across the world would want is for Russia's oil supply to be cut off.
This was, in a sense, an attempt to have your cake and eat it, to have a sanctions regime that punished Russia but didn't harm the global economy. Now, it succeeded in one sense of that. The global economy has its problems, but oil prices aren't a huge part of that right now. But on the other hand, it's not punishing Russia, but it shows that sanctions have unintended consequences, and those unintended consequences can be unpalatable.
There is every incentive to cheat. The penalties are tiny. They clearly want this to flow. They clearly want the oil to flow. There is clearly a real desire from the G7 to prioritize the flow of petroleum. That's just reality.
There's no doubt if the oil price continues to rise and the oil continues to flow and more of that oil trades above the price cap, then that means more money for the Kremlin. And the Kremlin will use a lot of that money to buy arms and to pay soldiers.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
To the Bloomberg Markets Magazine interview. I'm Shonali Bassick. For every Markets Magazine, we go in depth with a key newsmaker, an industry up-and-comer, or a disruptor. And this time, we spoke to Max Levchin, the CEO and founder of Affirm. He doesn't think you should be buying a cup of coffee on a revolving credit line and have to pay it off over the next decade. And that could be the elevator pitch for Affirm and other players in the world of buy now, pay later finance. BNPL, as it's often called, promises to be an alternative to high-interest credit cards and a lifetime of debt. And the concept is nothing new. A customer pays for a $1,000 television and pays for it over 4 $250 payments. And at Affirm, it acts like a 0% loan. But if a customer pays late, then many of Affirm's rivals will charge late fees. The use of BNPL has exploded in recent years, with more than $24 billion in BNPL loans estimated to have been created in 2021, according to a critical analysis by the Consumer Financial Protection Bureau. But as BNPL has gone mainstream, it has attracted more competition, with PayPal and Apple joining the fray, and more regulatory oversight, with the CFPB concerned about some aspects of the model. Here's Max Levchin on what caused the buy now, pay later revolution.
America runs on credit, and that's not a bad thing. You can borrow today to go to school and get a better education and have a marketable degree, and we buy homes on credit so that we have a nice place to live and build a family and create more opportunities for American economy to grow from the labor of our children. So credit is not a bad thing at all. The problem was credit that on the consumer side of things, it devolved into what should be known as buy now and pay forever, which is lines of credit, on a piece of plastic known as credit cards. If you are not extraordinarily well-to-do, and that's vast majority of Americans, you will eventually find yourself revolving, which is you're carrying a balance and you don't know exactly when you're going to be out of debt. And you seem to be paying and paying and paying, and yet your total indebtedness doesn't seem to be going down very much. Around 2008, an entire generation of what were then kids who are now millennials saw what happens to their parents who were knee-deep in debt and didn't know exactly how to get out of it, and realized that there's got to be a better way. The birth of buy now, pay later, and in particular, what we call internally honest finance, which is what Affirm wants to be or is this idea that there's got to be a better way. Instead of buying now and paying forever, maybe you could have certainty and control around your personal finances that does not require walking around with an Excel spreadsheet at all times. All of that is a secular momentum that began years ago, and we were there to grow with it. Affirm in particular, and buy now, pay later writ large, is the secular shift by young consumers away from revolving credit and credit cards into much simpler to understand, pay over time, individual transactions.
You were talking about the post-2008 generation and the worry about their parents being saddled with debt. But there's another generation that is still saddled with debt. Now they're credit card debts, student loan debts, and debts tied to homes if you can afford it. How do you speak to kind of the financial habits of this country and what might need to change?
I think we're doing our part when we speak to the entire American populace. And by the way, we're now live in Canada, and certainly aren't planning to stop in just the to North American giants. We have plans for a worldwide version of this company, but we do see our job as much a tool for purchasing as a guide or co-pilot, if you will, in your financial decisions. Our job is to help you make sound financial decisions every time you're deciding to buy or not buy, to finance or not finance. And it's a big job, but somebody has to do it, and we think we're up for it.
How are the financial habits of other places in the world different than perhaps what we're seeing in this country and even Canada?
The good news is that a lot of the world is already buying things on installments. So we're not bringing in an entirely new idea. And a lot of the world runs on credit very cautiously, as in they are prone to looking at financing things through the same lens as we are. And so, ask me again how we're doing in other countries when we launch there, but we feel very optimistic that the demand for the honest financial products, as we interpret them, is going to be significant everywhere, not just North America.
About a year or so ago, when Jamie Dimon was asked about his biggest competitors, we talk about this a lot, that he name-checked a firm, that you and your model was one of the biggest kind of incumbents to the traditional financial industry. However, the banks have also seemingly begun to partner with you more, particularly regional banks. What role do they play in your lifespan?
I find it very flattering that someone as at the very top of the most powerful bank in America sees us as an important competitor. I don't think it's a statement about us. It's a statement about the idea that revolving on a cup of coffee is a model that's probably going to go away over the next few years. So I think that's good news writ large.
Do you think that the buy now, pay later model creates new risks to an industry that are maybe underappreciated from the get-go?
I think buy now, pay later model creates risks for credit cards. And frankly, it's a good risk that I am happy to add fuel to that particular fire. You should not revolve on a cup of coffee. You should not feel that you have no idea when you'll be out of debt. Buy now, pay later, and Firm in particular, are the predictable outcomes product that is an alternative to the completely unpredictable version that is offered to you by traditional credit card issuers.
Max, you're kind of leading this hard charge, it seems, to kill the credit card. Where does this come from in you?
I'm definitely not trying to kill the credit card. I think there are folks for whom credit cards are probably perfect. A lot of them live on coasts, make 6 or more figures in salary, and really enjoy their airline miles and perks and benefits, etc. But I do think a tremendous number of people in quote unquote normal America. I grew up after immigrating from Ukraine. I grew up in central Illinois, went to school in central Illinois. There are plenty of people who revolve. Half of this country revolves on a $5,000 plus. I don't think it's a good thing. I think we would be a financially healthier nation if we knew how to borrow intelligently and not overextend ourselves. So it's not a quest against something. It's a quest for healthier financial lives for everyone who doesn't live in New York and Los Angeles and San Francisco.
Coming up, how buy now, pay later firms are responding to higher interest rates. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Bloomberg Markets Magazine interview. I'm Shonali Basak. BNPL has been rising in popularity, but so has credit card debt. Take a listen to just how much Americans have loaded up on borrowing. Households in the U.S. have racked up more than $17 trillion worth of debt through the third quarter of 2023. While the lion's share of that is mortgages, what can't be ignored is the stunning rise of credit card debts past $1 trillion. It's an emotional level for an industry that's quickly growing. And with more credit card debt, there are also more delinquencies. Still, by comparison to credit cards, the buy now, pay later market is small. Globally, it's estimated to be over $300 billion for 2023, according to consulting firm Global Data. It's growing at such a significant rate that it could hit more than $565 billion in 2026. Global Data's report warned of the risks to such growth, saying that if a borrower defaults, it could add more to their total debt load. And the more debt and fewer repayments means more late fees for customers. Global Data says that customers' credit scores could ultimately be negatively impacted and that the industry could use more regulations. And this echoes the CFPB concerns in a 2022 report, which cites the rapid growth of the BNPL model, a whopping tenfold increase in just 2 years through 2021. The Bureau said that one risk was that customers could become overextended, taking out too many BNPL loans across too many lenders. Now, the debts have piled up just as the Federal Reserve has raised interest rates at the fastest pace since the days of Paul Volcker, leaving Americans vulnerable to more expensive debts. And the move also caught some businesses off guard, most notably with the regional bank collapse of SVB. And with such an interest rate sensitive business, I asked Max how a firm is responding to a higher for longer environment.
As the Fed hiked the rates at the unprecedented pace all through last year, we had to adapt and move with it. Obviously, we are not a bank. We're not a depository. Therefore, we don't just have capital sitting around for lending purposes. We have to go borrow or sell our loans to buyers as the price of money went up. So we had to figure out how to finance our business, our loans appropriately. The good news is that we're able to maintain our margins, and this notion of higher for longer doesn't scare me one bit.
You're seeing the number of charge-offs start to rise at a lot of banks, and even with higher interest rates, credit card debt in the United States has surpassed $1 trillion, a really landmark moment. So what does this mean for customers of yours for interest rates to be higher for longer?
The thing that I would like to believe it means for our customers is they will use Affirm a lot more than they use their traditional credit cards. We are a better product. We are a viable replacement for credit cards. And that's because we give you a sense of control by always disclosing exactly what the cost will be up front. We don't charge late fees. We don't allow it to revolve. We don't have these ridiculous deferred interest schemes embedded in our products at all. And so it's a better product, and higher for longer, I think, means more people will use Affirm.
Are you saying that higher for longer, higher interest rates means more people will be using buy now, pay later? And why is that?
Buy now, pay later means a lot of things to a lot of different people, so I'll just speak to Affirm. I do think that higher for longer means people will need and crave certainty and clarity around cost of credit. When you're borrowing money and it costs you more money than it did during the zero interest rate environment, you want to know exactly when you'll be out of debt. You want to manage your cash flow much more precisely because every dollar counts, and inflation